this period in time on the timeline, this looks like a great time for investors in equities.
I would definitely still be long treasuries between now and the end of next year, but with a nod to the fact that it will be a choppy ride.
What I find the most concerning about the last month is there's been a massive risk-on rally on weaker economic data.
We are now starting to see lots of different things trickle into the economy, which will make the economy likely fall over next year.
I think it's incredibly important to remain invested, even in times of uncertainty.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get straight to it. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P 500 positive by a third of 1%. A major move again in the bond market. TK, Treasuries advance, yields lower. We're ignoring Governor Bowman. We're focusing on Governor
was
Waller.
That something? I mean, it was really important to see that, the differentials here of governors and presidents and which ones matter to the market and all, but it was a real jump condition. The first thing I looked at this morning, John, was the different technical construction of the market. I didn't realize how much we'd surged higher. I completely have missed the idea that we really haven't broken support. Katie Kaminsky yesterday nailed it. We could still go higher in yield because technically we really haven't rolled over yet. You look at Kaminsky yield and this fancy phrase technical support, we're coming down. We're getting right near that tip point where we decide lower yield or higher yield.
It's a 70 basis point move in about a month.
Yeah.
Let's go through the numbers. We went through 5%. We're down to about 429. We're down another 3 basis points in the Treasury market. This is a change for Governor Waller. Super hawkish. Now he's basically suggesting to the market he's done and some. Something appears to be giving. Bramo, his words, and it's the pace of the economy.
Yeah, he said if we see disinflation continue for several more months, I don't know how long that may be, you could then start lowering the policy rate just because inflation's lower. He's saying the unspoken words that the Fed didn't want to entertain, which is entertaining and discussing rate cuts at a time when you're still seeing a robust U.S. economy.
And Bill Ackman with his David Rubenstein interview, a lot more on that in the coming days and weeks. John, he went to the real yield moments ago. I got a 206 handle, 2.07 right now in the 10-year real yield. Could you imagine a 199 real yield and what that means for the likes of Professor Waller?
Attention turns now to Chairman Powell this Friday. Let's see if he endorses some of the language that Governor Waller used yesterday. Intriguing, Lisa, to your point, that we ignored Governor Bowman, who's saying something totally different, and focused on Governor Waller. It tells you something about the bias of this market at the moment, doesn't it?
It tells that people are focused on disinflation. They're focused on figuring out just how soon they can declare victory for the Federal Reserve, that they've achieved their soft landing. And it fuels this feeling that everyone got it wrong, that they actually were able to achieve a soft landing this year. Maybe, if we did. So maybe lean into that for next year. Again, though, does that tell you more about sentiment than the actuality on the ground?
Running counter to this slowdown story in the economy, retail spending in America, record shopping, Black Friday into Cyber Monday, going into the holiday season. What matters more, how much the consumer in America is spending or how they are spending? Buy now, pay later. Some of the stories out there in the last 24 hours. This from the Journal. A 43% surge from last year, according to Adobe, Lisa, in buy now, pay later options.
I was thinking so much about this week because I saw the 14% surge just year over year in terms of Cyber Monday and the buy now, pay later. Number one, how much is this younger individuals who feel disenfranchised or don't want to participate in credit cards, right? That is one aspect of this. The other aspect of this is you see something, you like it, you buy it, you don't think about how you're going to pay for it over the longer term and how much it sort of fuels the ability to keep spending even beyond someone's means.
Yeah, I mean, if you look at a refrigerator, John, I mean, are you going to do buy now, pay later on a refrigerator?
We'll ask the question
put
direct.
It on there at 28%.
Did we do buy now, pay later, or did we pay cash?
We paid cash.
We paid cash.
There
they
we
paid
go.
cash at Casabramo.
The Calvinist theory with Lisa Abramowicz. There it is.
Lots of people did not. Lots of people did not. They reached for buy now, pay later options. Payments company Block, this again from the Journal, saying that sellers using its Square and Afterpay platforms registered a record 70 million transactions over the Black Friday and Cyber Monday weekend, up 14% from the previous year. Reported a 19% increase over there in buy now, pay later purchases made through Afterpay. So, Tom, you've got data from Adobe and data from Block there, backing up the same story. There was a lot of reaching going on over the weekend.
On a digital space and the digital future of banking, they're having meetings today about what do we do. I don't want to to be dramatic. The death of credit cards, no. But people are revolting against 26 and 28%.
We'll come back to this story in just a moment. Here are the scores. Equity markets look like this on the S&P 500. Positive here by 0.3%. Yields a little bit lower on a 10-year again, 429.36. Lisa, the 2-year down 3 basis points. It's a break of 470 on a 2-year. The middle of October, for what it's worth, we were looking at 525, 526. We're back down to the 460s on a 2-year.
To see the benchmark bond yield in the United States fall by a percentage point in just the space of weeks is really quite shocking. And this perhaps is why the story of disinflation, or rather the mystery of disinflation, how far we are in that process. At 8 a.m., we'll get the latest read over in Europe. Germany's headline CPI, headline price inflation is going to come out. And this is going to feed into tomorrow's read in the rest of the Euro region. How much are we seeing this in a way that's sustainable? Earlier today, we got Spain's CPI, and it came in lower than expected, but still 3.2% above the expectation. At 1:45 p.m., yesterday I was kind of dismissive about Fed speak and how much they could actually move the market.
You weren't alone. So was I.
And I was completely wrong. And I wanted to say that because Chris Waller absolutely moved the market. Do people pay attention to Cleveland Fed President Loretta Mester when she's speaking about financial stability if she says anything other than leaning into the idea of rate cuts next year? Kind of to the point that we saw yesterday.
Apparently we'll listen, Lisa, if they say what we want to hear. That seems to be the takeaway from yesterday for me. Which maybe is the reason why at 2 p.m. when we get the beige book from the Federal Reserve, how much are people going to look at anecdotes highlighting that slowdown that we heard from Walmart's CEO?
Really?
Which really has been the reason maybe that we have seen the U.S. Economic Surprise Index fall to the lowest level since April of this year. I'm just going to keep talking.
Victory Lab.
I don't know who he's talking
7-year auction. John, Victory Lab, Bramo, 7-year auction.
No, actually,
you did it again. I mean, there it was.
It was, but it actually wasn't that good.
And then it came right
back.
no one
cared.
It was like, why is that? It spiked up, world's coming to an end, and it came right back down to where it was before. Why?
Because a failed auction didn't fit the narrative of the day.
Okay.
I'm with Bramo. I'm totally with Lisa on this. Governor Bowman says one thing, open to more hikes, thinks that maybe base case we need them. And Governor Waller is basically saying we're done. And we're putting more weight on one voice than the other. And I get it, it's a shift from Governor Waller. I understand that. It's a shift from where we were maybe 12 months ago. But there are still some voices out there, Tom, pushing for something different.
People in the backstory here, and this is with great respect to Ms. Bowman, people have an immense respect for Mr. Waller, academic respect. They really, he walks in a room, people take notes.
Tell us what you really think.
Yeah, no.
Hey, we'll have this conversation a little bit later. Joining us now, Christian Knowlton, Global Chief Investment Strategist over at Deutsche Bank Private Bank. Christian, I want to start with the retail sales through the weekend, the holiday spending here in America. What matters to you more, how much consumers are spending or how they're spending?
I think timing-wise, of course, short-term, how much, which is positive, but then I think you have to pay the bill, right? And you talked about pay now or pay later. I think as we are saying high for longer, the bill is higher probably for the consumer than some people might think. So from that perspective, something to be watched.
Christian, in your note, your view forward note, you have a magnificent phrase which really sums up the angst of the moment. You are in search of 10% growth. How do we find 10% growth next year?
Well, I would say in general, we are in search for growth because we do expect economies to grow at, let's say, slightly below 1%. That's true for Europe. That's true for the US. You would only see higher growth rates in China, India, where you have sectors where there is more than 10% growth, even on single companies. They should do very well in this environment. And you have seen some sectors where this is continuously the case. And I think in the environment we see for next year, that should still give us some quite decent performance.
Your outlook calls for 175 basis points of Fed rate cuts next year. It talks about how it looks like something a bit harder than a soft landing. And yet there is this optimism around equities. This is confusing. How do you put these things together?
So I think the outlook comes to 175 rate cuts in case of a severe recession. I think that you have to also look at the other side. If there's no severe recession, I would say it's rather a mild recession, then we probably get 3 cuts from the Fed and also from the ECB from our point of view. And so it could be a more volatile beginning into the year, and then it should calm down. And if you think of volatility, and Tom, we talked about this last time, bond volatility is still higher than equity volatility. I think equity volatility is priced for soft landing. So everything which gives us concerns on growth, would probably also increase equity volatility. That could happen maybe at the beginning of the year, but should calm down in the second half.
Who's right, Christian? This idea that we're seeing this massive deceleration in the consumer, the fact that we heard from Walmart, the fact that we heard from Target, the fact that you see the economic surprise index rolling over to such a degree, versus the perennial spending that just keeps on happening that John was just talking about, versus consumer sentiment that we saw yesterday tick up higher than people previously expected. How do you put these ideas together?
I think, again, it's a bit the timing effect, right? You have still some consumers that want to spend, really, as you rightly said, I think. But if you hear more that the economy is slowing down, and so far we have not heard so much about this, to be very honest, I think then the consumer will also lower expectations and react to this. And that's exactly the picture we have for the beginning of next year. So lower growth in the US, not only there, by the way, and that should also somehow impact the consumer.
Christian, from across the pond, is there a pressure to own America? And if there is, how do you do it? How do you affect a policy to buy America?
I think if you look at performance in the recent years, if you look at potential growth rates, I think there's no way not to own America, right? If you look here in Europe at potential growth rates, it's, I would say, substantially lower than in the US. So I would be surprised if you see a decoupling of Europe from the US. Especially, there's a lot of discussion about valuations here in Europe, which look very, very cheap compared to the US. But I think it needs to find a trigger that people look into Europe. So for the time being, is really about owning the US. And I have not seen that trigger to move to Europe at this point in time.
Christian, there just seems to be a radical difference in the transmission of monetary policy, the channel to do so in the United States versus Europe. I was looking at the bank lending data, credit data in Europe. Just how challenging, Christian, are things in the European economy right now?
If you just look at the growth perspective, right, we are literally in the same number for Europe than the US. I'm just saying the potential growth rate is stronger in the US. And if you look at the composition of indices, S&P versus, for example, Euro Stoxx 50, much more on the growth side towards the S&P, much more probably on the value side, more export oriented. So I think it's a different composition of growth. In terms of China getting stronger, that would be positive for Europe. In terms of lower yields, that's rather positive for growth, and that's probably more positive for the US.
Interesting. Christian, thank you, sir. Christian Nolting there of Deutsche Bank, private bank, on the outlook there for the United States versus Europe. US exceptionalism in the equity market has been a major theme, Lisa, for all the hopes and dreams of international outperforming. Luxury in Europe faded pretty quickly. We were talking about the miners and China reopening. That story faded pretty quickly. Here we are talking about the Magnificent Seven at the end of the year on the US equity market.
I guess that the one real takeaway from 2023 is a story of artificial intelligence dominated and grew through the year, with people building on it in terms of its application and potential productivity gains. So if that's the case, people kind of lost interest in the luxury story. People kind of lost interest in the mining story because China underperformed. I'm waiting for people to lose interest in the Ozempic story because a lot of people have said it's gotten overplayed.
I refuse to. I love that story.
Why do you love this story?
I love that story. I just think that a pillar of this economy in America is built on obesity. That when you're looking at a country that's made up of a third, maybe pushing 40% of the population is obese, think about the changes you could have off the back of that drug. I think it's that big. Number one killer in this country, I think, is heart disease, right? Imagine if you start to change that, people start to live longer, where the money starts to get spent. If it can do more for things like addiction, say beyond obesity, to gambling, all kinds of things. All kinds of things.
I don't disagree in terms
again
of the
and again
scope
and again.
Of it. Yeah, I don't disagree with the scope of it, but the question is, I believe it's rather expensive. Who's going to pay for it?
$900 a month. My question is just side effects, number one.
Sure.
Number two, who's going to pay for it? And number three, the sustainability over a longer period of time.
Exactly.
But you're right. I think it's transformative, potentially.
For many, many sectors.
Why are you looking at me?
I'm not.
You're looking at me.
I'm not.
I mean,
it's not personal.
It's not personal. Did you do 10 or 15 miles
It's not personal. Equities on the S&P, positive from New York. Good morning.
Of course, we will be talking about the crisis in Gaza and the broader Middle East. I'm very pleased to see hostages returning home, coming back to be with their loved ones. And we're determined to continue that for as long as possible, to bring as many people home as we possibly can.
That was US Secretary of State Antony Blinken speaking earlier today in Brussels as he attends a two-day NATO meeting. Blinken is set to make stops in Israel, the West Bank and the UAE in the coming days. Live from New York City this morning. Good morning to you. The scores look like this on the S&P 500. We are positive by a third of 1%. Yields lower again. It's a break of 430, guys, on the 10-year. 428.59. We're down 3 basis points. Lisa, only a month or so ago, through 5% on a 10-year and a conversation about 6, maybe even 7. The never-ending bond market sell-off, and here we are. Crash landed.
I think that even we heard 8% out there thrown as a theoretical number that was not unreasonable. We're looking at a situation here where people have whipsawed back down to disinflation and buying in. So the question is this the final move, or is this just the latest episode in a very dramatic whipsawing year, right? And honestly, this is a serious question, especially given the fact that you have the likes of Andrew Hollenhorst talking about underpinning inflation that's going to resurge early next year.
And the derivative guys, all the year-end views of various quants has told me that they're looking at collared trades. They're looking at this way or that way. Nobody's really calling a direction. They're saying, hey, here's the setup to go to lower yields. Here's the setup to go to higher yields. That was really stark yesterday between Katie Kaminsky looking for higher yields versus many, many others looking for a trend here below 430.
What is the bet for next year now? What is it? Below trend growth?
The bet is we'll be here.
We get rate cuts and we don't see much damage to the labor market. Is that it?
I don't know what the consensus bet is, Mike. The bet is to stay and hang on every data point. We're going to do that today with a second look at Q3.
The bet is it doesn't matter what your economic outlook, stocks will do well in the U.S.
It seems to be that way, right?
Exactly. I mean, that's just basically
looking at some of the calls.
Seems to be the
Takes
consensus.
a while to form consensus. We were talking to Laurie Calvasina of RBC about that earlier this week. It just feels like consensus has quickly coalesced around this view that below trend growth but no recession, rate cuts are coming. And ultimately, it doesn't matter if you do get that recession, stocks are okay.
Yeah,
that's like the consensus view.
100%.
Yeah,
ranges
I agree
like
with that,
4,700, 5K, 51, something
Pretty
like that.
narrow range.
I'm less focused on recession and more on what nominal GDP is going to do, and that's got two moving parts: the inflation part and the real GDP part. And I take the point; it's wildly open to review, and that's this data dependency that we've got. We've also got data dependency in looking at the politics of the nation. Joining us now, Greg Valliere, Chief U.S. Policy Strategist, AGF Investments. Greg, I got 8 ways to go here with the different narratives that are out there. Let me just start, as we just saw the Secretary of State doing what Henry Kissinger used to do. Do the Republicans have a foreign policy?
They are divided, very divided on foreign policy, as Nikki Haley and others have shown, between hawks and people who are more isolationist. The good news is that we have established lines of communication between Israel and some Persian Gulf countries, with the U.S. and others being intermediaries. The bad news is, and this is getting worse by the day, I'm not sure about aid to Israel, Ukraine. That's starting to slow down in Congress.
Nikki Haley has a lot of effort here. She is the 29th United States ambassador to the United Nations. How foreign is Nikki Haley to Republicans?
Well, to many Republicans, she's viewed as not a preferable candidate. The thing, Tom, that strikes me is that young conservative Republicans are indifferent to aid to Israel or Ukraine. I think it's a great mistake. I worry a lot about Iran. I worry in terms of Ukraine that Putin could start thinking about Lithuania, Estonia, Latvia, other places to invade. This is a real threat, but I sense isolationism is growing in popularity in the U.S.
Greg, to that point, there was a poll by the Harvard-Harris organization that came out. It was written in a Wall Street Journal article yesterday showing that roughly half of Americans aged 18 to 24 years old think that Hamas's October attack was justified by grievances of the Palestinians. And they talk about how they are looking for not only a ceasefire, but feel like there's a real tit for tat. Just 9% of people age 65 or older feel the same. Greg, how much is the divide of the generations wider than it has been in the past?
It's a really big deal, Lisa. And I think it's not just on this issue. It's on student loan relief. It's on guns. It's on immigration. It's on a wide range of issues. And I think for the White House, it's astonishing now to see that among that young group you cited, Biden trails slightly. He won that group by 20 points in the last election. If it's tied, he loses.
How much, Greg, is it something that he wants to cater to versus just shrug and say, well, they're not going to show up anyway? I mean, at what point are these voting individuals in the country versus people who are being active on college campuses and social media but feel kind of marginalized, frankly, in the political sphere?
Yeah, it's the marginalized people is a puzzle the White House can't solve. The marginalized people think the economy is terrible. I would disagree. And it poses a real threat to Biden's reelection.
I got to go to the news over the weekend, Greg, and the thundering silence of the GOP in the Senate over their candidate going after something 13 years old. That's the Affordable Care Act. Obamacare. Yeah. I was really just the divide there between what President Trump desires second time around versus his team. I believe I've never seen that, Greg.
It was a remarkable development. In sports, we talk about unforced errors, and this was an unforced error. Yeah. I think that Trump is a loose cannon on a lot of issues. A lot of veteran members of Congress were like, what? He wants to reopen Obamacare? It's settled. The public likes it. It polls well. There's no alternative. Yet Trump wants to raise the issue. I think that would be disastrous.
Totally unfair, Greg. What's the first 100 days of a Trump administration look like?
Vengeance. Vengeance more than anything else, Tom. I'm not even sure what his agenda is.
We got Greg freezing. Greg's freezing.
I think he wants to get back at people who have slighted him. I think he wants a Trump. I think that is going to be the biggest concern.
Hey, Greg, got to leave it there. Apologies about the technical problems towards the end of the conversation there. Greg Valliere of AGF Investments. I was slightly distracted here. Sometimes the title of Southside Research really catches your eye. And that is why you open it and read it. This from the FX team over at Wells Fargo. Goldilocks and the Five Bears. Do you want the Five Bears?
Please.
Okay. So base case is weaker dollar into next year. I'll give you some of the bears, okay? We caution against extrapolating out the dollar's near-term weakness too far into 2024. A realization of a broader global slowdown could take place in the first half of next year. The prospect of significant rate cuts, lingering China weakness given structural issues, rising global geopolitical risks, and drum roll for a fifth one for you, a heavy 2024 election calendar. Next year's a big year. It really is.
Yeah, it is. And by the election calendar, John's talking about global elections, the many elections worldwide, and we sort of stagger from one to the other to the next. But it does speak to, you take the IMF gloom out there and where global GDP is going sub 3%. All sorts of bad things happen with sub 3% global GDP, which means what do? You buy the dollar. So maybe it's not strong dollar, but maybe it's dollar resiliency pushing against the consensus.
Maybe the Five Bears are the reason why there's very little conviction other than buy stocks because tech is still going to take over the world. I mean, essentially, is that the reason why we're seeing people come out with varying prognostications about the economic outlook, but the same one when it comes to Amazon and Apple and Google and OpenAI and Microsoft?
Sam Altman.
There we go. Line them up.
Mention Sam Altman for 5 minutes.
I just wanted to.
Sam Altman
that's
OpenAI.
Well, I mean, honestly, this is sort of the story that, you heard Mike Mayo yesterday talk about it, about how this is going to really fuel bank earnings with some of the efficiencies there.
I think Charlie Munger was right on AI. There's clearly going to be some winners, but can you imagine the number of losers who go into a concept of AI without the intellectual authority that we're seeing out of, Microsoft and others? John, I think what we can establish here as a trend for next year is if you got 5 bears at Wells Fargo, we know where the 6th bear is. There's just no question about it right now. Bramo is the 6th bear.
Bramo's consulting over at
Wells.
Wells.
Put on my suit, show up at the holiday parties. I'll tell you my glue scenario.
I'll show you. They're thinking they're going to have a nice drinks, warm moments, some canapes maybe. For the holidays, talk about Christmas and
the 6th bear shows up.
Your plans, and Bramo shows up. Let me tell you about your call for next year. 5100, I don't think so. TK, you mentioned Charlie Munger, the late great investor, partner to Berkshire Hathaway's Warren Buffett. We're going to spend a bit of time with a tribute to the man himself.
I'm so honored that Doug Cass has found time for us today. Doug Cass knows this tandem like nobody.
Doug Cass coming up later this morning. Howard Marks of Oaktree as well. Big conversations on Bloomberg Surveillance. Actual quote, Bramo, commercial break. I'll be happier this segment. Actual quote, verbatim.
The context.
Well, you can share the context in a moment.
It's okay.
Equities on the S&P 500 positive
For next
here.
year, we're doing big little
by 0.3%.
You're going to see us on the break.
Live cam of Bramo in the commercial break with audio.
She ignores us, just so you know, folks.
Equities on the S&P
like
down a third of 1%, or rather up a third of 1% this morning. On the Nasdaq 100, up 0.4%. Yesterday, the stock market pushing out a small day of gains. The rally in November stalling out, I have to say, recently, Lisa, over the last week or so.
Yeah, really, I think that there's a little bit more recognition that bad news is not necessarily unmitigated good news. And I think that there is a feeling, a concern about what some sort of slowdown could percolate into.
Still on course for the best month of the year on the Nasdaq. Quite phenomenal. Off the back of this move in the bond market, 2-year. Let's just sit on a 2-year, front end of the curve. This yield, mid to late October, 526.
Wow.
469.71. Down another 4 basis points. And this bond market yesterday, choosing to listen to Governor Waller much more than choosing to listen to Governor Bowman.
Like at different levels, they're technically 4.14, even a 4.04. But, John, to the addiction of equity markets up, and all of that since Halloween is the basic idea that we've really at stasis. Have we rolled over? I don't see any violation of moving averages here. We're just noodling along, waiting for the next news.
It's the psychology of
more
the top.
7 stocks.
So think about it right now. You've been telling clients for a while, consensus view on Wall Street, lock it in. Lock it in.
That worked out.
They're worried about the reinvestment risk a year from now. If you are sat in T-bills and you maybe sit here 12 months later, will you be happy you have dry powder to allocate to the equity market, or disappointed that you didn't go further along the curve and lock in this yield? So when you get this move from 5% to 4.30 on a 10-year, Lisa, all of a sudden the attitude starts to change. Only 30 basis points from having a conversation about the 3s, then people really start to feel like they've missed out on locking in 5 for a whole lot longer. And this just feeds on itself. In either direction, by the way, every time you have a 50 basis point move in one direction to the other.
Which raises this question, are we going to see next stop sub 4%, or is this going to be the trade, the collar that Peter Scheer was talking about, 425 to 475, and bouncing around from one to the other as people's moods shift depending on the data and the wind and the bears?
Well, to your point, the conversation just changes radically from one 50 basis point move to the next.
Yep, pretty much. That's
and if you
basically
ask
right.
people in fixed income, where do you believe the next 50 basis points is, lower or higher? I kind of struggle to answer the question, Lisa, going into the start of next year. If you give them a 12-month view, where do we land? They'll say lower yields. Lower yields. But tell me where the next 50 is. Tell me where the next 5% in the equity market is. Give me a tactical, Tom, tactical call on this market.
Tactical call, I can say, is the momentum's there in 7 stocks, and you got 493 others, including Generous Motors, that maybe aren't there. What Mr. Munger would say, and Mr. Buffett this morning, is use of cash matters, and maybe that's how you get Christian Nolting's 10% growth.
Let's get to your top stories this morning. Under surveillance, Charlie Munger, the man who built Berkshire Hathaway alongside Warren Buffett, has died. Buffett paid tribute to Munger, saying the company, quote, could not have been built to its present status without Charles's inspiration, wisdom, and participation. Munger served as Berkshire's vice chairman and was one of its biggest shareholders. Charlie Munger, Tom, was 99.
99, a long and wonderful life. And to me, and I said this to Nathan Hager in radio here in the last hour, the singular feature, and I was a young kid, was the shock of 73, 74. He was formed by big double-digit negative losses. In what I call it the Pittsburgh recession. It's when Pittsburgh evaporated. But 73, 74, he lost a lot of money. And that framed his humility forward.
He also had great wit, and one of the quotes
Razor
that
sharp.
I loved
Like Ferro.
that I was reading yesterday, and some of the tributes to him. Around 2016, an acquaintance asked which person in a long life he felt most grateful to. My second wife's first husband, Munger said instantly. I had the ungrudging love of this magnificent woman for 60 years simply by being a somewhat less awful husband than he was.
I've not heard that quote before.
I'm not going to comment on that.
Absolutely.
Do I have to comment?
Brilliant. That is absolutely
Isn't that
brilliant.
just like one of the best things? I love this.
Can you give us your official view of the situation?
No, I'm not going there.
I love that quote. To me, the love stories behind some of these figures, the 60, 70, 80 years that we talk about, really is notable to me.
Come on, is it the zip code? It's Omaha. I remember I was stuck in an Omaha bus station a million years ago, John. Omaha is not Manhattan, and that's to me, that's a huge advantage. You put your pants on one leg at a time. A lot of people in Manhattan don't do that.
Let's not go there. There'll be a tribute to Charlie Munger throughout this morning. We'll catch up
Howard
with Doug
Marks.
Cass and Howard Marks. Howard Marks joining us at about 8 a.m. Eastern Time. Look out for that. Your second story, talks underway to extend the truce between Israel and Hamas as the deal enters its final 24 hours amid accusations from both sides that the truce was violated yesterday. Hamas releasing 12 more hostages. US Secretary of State Antony Blinken scheduled to arrive in Israel tomorrow. Lisa, accusations about a violation of this framework for a truce in the last 24 hours from both sides, and yet still it's a truce that holds. What do you take away from that?
There are reasons on both sides that people want this ceasefire to take place, temporary ceasefire, but there is no reason why either side wants to see the conflict end in its entirety. And I think that's the takeaway, that right now, Israel's under an incredible amount of pressure to bring the hostages home. Hamas needs to reboot, wants to regroup. A ceasefire, in James Stavridis' words, is actually going to benefit, arguably, Hamas more than Israel at this point, barring just getting the hostages home. After that, the goals have not changed. The animosity, if anything, even larger. How are we going to resolve this?
No, we're not going to resolve it. We haven't resolved it since, I'll go back to 67, and other experts would go back to 1948 or before. But to your point, Lisa, I thought you were quite good on this in the last couple of days. The day-by-day ceasefire, even with certain violations here and there, has to have a cumulative benefit to all. But then it ends. And I have no idea how close we are to that phrase.
Yeah, let's see when it ends and whether it gets extended. That's going to be a big part of the conversations today and into tomorrow. Turning to the big story of the last 24 hours in this market, the Fed rate cut debate, the conversation. Fed rate cuts could come as soon as the first quarter of next year, according to billionaire investor Bill Ackman.
But I think there's a risk of a hard landing if the Fed doesn't start cutting rates, pretty soon. So, I think the market expects sometime middle of next year. I think it's more likely probably as early as Q1.
That's Bill Ackman there, the full conversation with Bill Ackman on peer-to-peer conversations with David Rubenstein on December 6th on Bloomberg TV. I kind of understand what Bill is saying here, Lisa, that if you are worried about the cumulative tightening, if you want to time this perfectly, which I think is near impossible, but ultimately you can understand the reasoning as to why you'd have to start easing earlier than perhaps the Federal Reserve is willing to engage on this particular conversation.
Agreed, which is, I think, what the market is kind of feeding into as well. What I find interesting is just that Bill Ackman got a ton of kudos after calling the market perfectly, saying he was shorting bonds in September, closing the short in October, and then riding this. So how much is he basically just trying to perfectly calibrate the emotional mood swings of the market right now?
We had to go out and find someone who could perfectly calibrate. That's Eric Nelson joining us now, macro strategist, Wells Fargo, and particularly on foreign exchange here. Good luck with that, Eric. Perfectly calibrate dollar trajectory for next year. Do you have a clue?
Well, Tom, the key here is, we're coming into the year and there's a lot of, I think, hope and consensus for continued dollar weakness throughout the balance of 2024. I think we're happy to sort of play for that in the next 1 to 2 months. We are seeing a positioning adjust. It's still quite long dollars. The Fed clearly becoming more comfortable with rates where they are, maybe even sort of shifting toward an eventual pivot. The question for us is, if we're going to end up in a broad-based global slowdown by, say, Q1, Q2, including the U.S., is that really an environment where you want to be short dollars? History says probably not. So I think you have to be very careful, and I think relative value opportunities, shying away from the dollar over the balance of 2024 may actually be the best course of action.
Eric, I'm going to give you a softball. It was your outlook that was put out about 10 minutes ago. I shared it on air here on Bloomberg TV and Radio. Goldilocks and the 5 bears. Eric, can you tell us what the 5 bears are?
Yeah, it's a couple things to sort of keep in mind here, John. I mean, one of the big ones is the global growth slowdown. I just, as I just mentioned, but there's a couple other things to sort of keep in mind. I mean, the big things here are, election calendar, certainly a big one, broad-based rate cuts across the G10 and EM and carry compression. And so I think those are the really big ones to focus on as we get into 2024. Question for me is, at what point do these bears kind of rear their head? I'm really looking at next week's U.S. jobs report. That is the big one, and sort of going to tell us, are we going to see an earlier turn to rate cuts, an earlier turn to global slowdown risks, or are we going to get another 180,000, 200,000 number, and we're going to continue to push out this rate cut outlook? And that's sort of where I think the near-term risk is for all these outlooks, including our own.
Eric, how on earth is it that binary going into year-end?
Well, I think we've seen a big move in positioning, John. So you look at the move in rates, you look at the move in FX. Yes, there's probably more room to go if you have a situation where it becomes clear, you look at Waller's speech yesterday, a great example. He acknowledged the pace of job growth is still okay. And so, yes, we've seen unemployment rise, but initial jobless claims haven't moved that much higher. And these extreme moves we've seen both up and down in rates and FX would suggest that there is room in a low liquidity market to see some pretty wild swings into year end.
So how much are you calling with conviction to buy the dollar versus just simply don't write it off, that it's just not going to be a clean trade no matter what you do?
Yeah, I think, well, and to clarify, I think we're not at a point yet where you want to be, long dollars. I think for the next 1 to 2 months, our base case is still continued slowdown on the labor market side in the U.S. Inflation stays low enough to give the Fed comfort to keep rates where they are, maybe start to hint at eventual easing. But yeah, as you get into crystallization of some of these growth risks, especially versus some of the higher risk currencies, I think that's where you can start to look at actual tactically outright buying the dollar versus some of these more risk sensitive pairs.
Is there a sense that some of the strength in the U.S. can continue, and that even if there is a rate-cutting cycle next year, and even if it starts in the first quarter, as we just heard Bill Ackman predict, that at least the U.S. will be cutting rates less in 2024 than, say, Europe?
Yeah, and I'm glad you brought this up, Lisa, because I think there is, in most normal times, non-recessionary times, FX is all about rate differentials, right? That's really the key. What becomes a little more complicated is in these global recession scenarios, that relationship can break down. Look no further than March 2020 when you saw rate spreads and the dollar move in completely opposite directions. So I think even though the Fed is probably going to end up cutting rates more than the ECB, given starting points, real rates, et cetera, it's not necessarily going to be euro-dollar positive. At the end of the day, I think we're going to see more consolidation in euro-dollar once these recession risks are crystallized.
Eric, great to get your view. Congratulations on finally getting the outlook published this morning. I know that's difficult sometimes. Eric Nasson there of Wells Fargo. Difficult to get everyone to agree, get everyone on the same page as to what things
Some
are
houses
look like
do
12
that.
months out.
Some houses want that, but other houses, like Morgan Stanley, is very fractious. They really
bit more
get
division.
Going. Yeah.
Need to turn to GM.
Yes.
GM, what a troubled
Bombshell.
stock. The stock is basically where it was 10 years ago.
Yes.
The multiple is at about 4 times less than 4 times forward earnings. The TK, the name, the market cap is less than 40 billion. And they're trying to do something about it this morning. The stock is up by 5.4%. So we've got a hike to the dividend, buying back $10 billion of stock, spending less on the robo-taxi unit as well. A lot of pressure on Mary Barra.
To me, it's a lot of pressure on Mary Barra, and way, way more than that. This is a bombshell for every CFO in the Standard & Poor's 500. There are 493 CFOs. They will go over this with a fine-tuned comb. Just to give you a perspective, Amy, give me this banner. It's so important on TV. I'll tell it on radio. If you look at the debt of the Magnificent Seven, GM, with their leasing and all that, is 72% debt. Apple is 4%. And yet this is a use of cash announcement like you'd see from the Magnificent Seven.
So we seem to be trading, Tom, on, I would say, the cut to investment in things like rubber taxis seem to be moving higher off the back of the capital return program, reinstating guidance. And just to get your hands around the new guidance, Lisa, net income will now be between 9.1 billion and 9.7 billion. The previous guidance going into these strikes, a range of 9.3 to 10.7. Of course, during the strike, Lisa, they had to withdraw that guidance. So new guidance just a touch lower. What do you make of this morning?
To me, $2 billion in fixed cost reductions. Yep. To me, the question is the cuts and how much this paves the way forward for others who are facing similar income constraints.
And maybe for more cuts at the same company further down the road. Much more on that still to come. Coming up shortly, Claire Lombardelli of the OECD from New York City this morning. Good morning.
Now starting to see lots of different things trickle into the economy, which will make the economy likely fall over next year. A story that I think is going to be very interesting for next year in FX is North America is the center of the slowdown. Asia is the center of the recovery, and Europe sits somewhere in the middle.
This is so important. That was Mark McCormick, the global head of EM and FX strategy at TD Securities. We caught up with him a little bit earlier this week. Coming into this year, the call was the slowdown was in the US. The outperformance would be in Asia, delivered by what was happening in China, reopening, consumers re-engaging with the economy. And then what eventually transpired, materialized, if you will, was the US outperformed and China massively underperformed. The call again, Lisa, going into next year is now for Asia to be the center of the recovery and America is the center of the slowdown, which is kind of like the 23 outlook on repeat.
Pretty much everything about this has been the 23 outlook on repeat. It was basically slow down, delayed, deferred, the disinflation accelerating, the sort of transitional kinds of inflation, that it's just transitory, reinstated essentially. And people are saying it's going to be a weak first half, but then the second half is going to be good, fueled by rate cuts and fueled by the sense that we've entered the new era.
What would you do if the Fed turns around in early next year and says it was transitory? It just turns around, it was all transitory, and basically tries to give them a nod, give themselves a nod to what they said 2 years ago.
They're not going to do that.
Like
I'm not
some
even
kind of weird victory lap.
They're not going to do that. I mean, the transitory was just tarred and feathered. It's not going to be them, and they're not going to declare victory. They're going to try to be quiet about it, but you are going to hear, we'd achieved a soft landing, or it seems like that. We're going to hear other words, but they're not going to use the T word. Come on.
That's the hope and a dream into next year. Futures at the moment positive by 0.3% on the S&P. The scores look like this. Cross-asset yields down again by 3 or 4 basis points. A 10-year at 4.2840. An update on a single name, General Motors, GM, in the pre-market up nicely. The stock is higher by 5%, $30 and about 35 cents in the pre-market. We'll be catching up with Mary Barra, the GM CEO, a little bit later this morning. I'll be interviewing her at about 9:30 Eastern time. Tom, the news this morning, hiking the dividend, $10 billion buyback. Lisa mentioned the cuts, reducing investment in the robotaxi unit. There's been some pressure there. Yeah, reinstating guidance just slightly lower than the previous guidance, but the capital return program maybe getting some cheers, the cuts to spending, getting some applause.
On the real economy,
let's see if it lasts.
On the real economy, John, I'm going to say this is the first big announcement of 2024. How many other companies are going to come out with attitude adjustments like this? This is the summation of this, as you mentioned, 1, 2, 3 different ideas. And it's the basic idea here is that this was pounded through to be a new GM, whether, right or wrong, it's not my opinion. I'm not qualified to have a view on it. But how many other companies, like lemmings off a cliff, are going to go, we got to act, starting with what Lisa mentioned.
The bar was low. Let's put it this way. The bar was low.
Huge low.
The multiple on this
Huge
name.
Low.
TK, you've been covering this way longer than I have. To see GM trading at less than 4 times forward earnings.
Yeah. Full
the stock
disclosure,
is where it was 10 years ago.
I have, and maybe I was colored, but I was sort of on the eastern Detroit end. It's called Rochester, New York, Rochester Carburetor. I've never owned the auto stocks, and maybe that's my childhood, but it's been such a train wreck for so long. Like Ite Macaulay at Citigroup nailed the ascendancy of GM, but you haven't seen it, John, in the stock price.
And given the labor costs, that development in the last couple of months, how investable are they now? Even with that capital return program. These are the conversations we'll have. But I think a lot of this is just skipping over a very low bar. And you see that with Foot Locker this morning. Third quarter comp sales, -8%. The estimate, -9.88. Can we get Foot Locker up in the pre-market? Lisa? Skyrocketing by 11%. Just kind of beating a very low bar.
Yeah, there basically is the bar to not file for bankruptcy. At this point, this is about inventory unwind and this idea of at least not performing as badly and not losing as much market share. How long can that last in terms of comps for next year?
Going into the open about a few hours away, $26 on that stock, up by about 9%. Let me get you the outlook for next year, according to the OECD, warning of a deepening slowdown in the world's advanced economies, predicting Fed rate cuts won't start until the second half of next year. This is the quote in their outlook. Unemployment will continue to edge up through the first half of 2024. Inflation will decline, allowing for monetary policy easing in the second half of next year. Tom, the outlook could worsen if the effects of tighter policy rates are stronger than assumed or lead to financial stress.
I can't say enough, John, how cautious this view is from the OECD. I would suggest they've been a little more optimistic than some of the shops. Joining us right now, their chief economist, Claire Lombardelli, with her work at London School of Economics, Oxford, and of course with the government of the United Kingdom. Claire, thank you so much for joining us. What I'm thunderstruck by is the duration of the slowdown. You have a 36-month average 2.87% real GDP for this world. Have you seen this before? Is there precedent for the duration of your slowdown?
We haven't seen global growth at this low level, for a period. Obviously, the global economy has previously grown at much higher historic levels than we're projecting here. But actually, what our projections today are for a fairly soft landing, actually, and a smooth landing. That's our central projection for economies as they go through, as inflation comes down and they go through the monetary tightening that we're now seeing.
How alone is a buoyant United States of America? How alone is America in your global analysis?
Well, we've revised up our projections for the US because obviously we've seen stronger data there and the economy is proving more resilient to the tightening that we've seen so far. I mean, they're not alone. Other economies are also, doing reasonably well. Japan would be another example, another country I would point to. And of course, across emerging markets, the picture is very mixed, with some emerging economies performing relatively well.
Claire, you don't expect the U.S. to start rate cuts until the second half of next year, which goes kind of counter to a growing consensus among investors that it's going to happen in the first half of the year. What do you think is going to take so long? Is it that the economy is going to be better than expected, or that the Fed's going to proactively be late to the game of cutting rates?
We've seen more strength in the U.S. economy than people had previously expected, which is part of what's going on here. I mean, there's a lot of strength in American consumers in particular, and so what we're expecting really is it to take a bit more time for inflation to come back to show a persistent downward trend and come back to targets, and that's why we're projecting a longer period of monetary tightening is going to be needed. Monetary policy is going to need to remain restrictive for a period.
You also don't think that the ECB is going to loosen policy until the beginning of 2025, even as we see inflation come down quite significantly. We're going to get pretty soon the German inflation read. And we got earlier today lower than expected Spanish inflation. Why do you think the ECB will be able to hold on to early next year, given that people are talking about stagflation, slowing growth, recession in the region?
I mean, we are seeing slowing growth in the EU, and again, we've revised down our projections there. We are expecting inflation to come down, but to come down sort of slowly, thinking about core and headline inflation. And so again, what we need to see is inflation persistently returning to targets, and that's why we're expecting and advising for a period of restrictive monetary policy while that inflation is squeezed out of the system. We've seen record rates of inflation in response to the shocks that the economy's been through, and so it will take some time for that to come back to target.
Hey, Claire, we've got to leave it there. Appreciate the update. Thank you. Claire Lombardelli there of the OECD. I think Governor Waller speaking to a lot of this. Some comfort, at least for Governor Waller. He alluded to this. I think it's highly suggestive in what he said. Tom, some comfort that policy is sufficiently restrictive to get monetary policy to get inflation back down towards target. And I can share the full quote with you. I'm increasingly confident that policy is currently well positioned to slow the economy and get inflation back to 2%. I am encouraged by what we have learned in the past few weeks. I'd love more on this, Tom. I'd like to know what he's looking at specifically.
Well,
something appears to be giving, and it's the pace of the economy.
His esteem is earned out of the research house. It's widely understood among the 12 Fed banks that St. Louis invented modern research. I won't bore you with the details now, but Waller is the distillate of 30, 40 years of Federal Reserve Bank of St. Louis excellence. And when he opens his mouth, people listen. What I didn't hear there, Lisa, was a job economy. And to me, I still go back to their dual mandate.
Well, this is the reason why I think immaculate disinflation is still very much on the table. One thing Chris Waller said, and I quote, "There's just no reason to say you would keep rates really high and inflation is back at target," for example. If inflation gets back down, maybe not even to 2%, but close to it, can they then call the all clear sign and start cutting?
Keep going back to that threshold question. Standard Chartered, Eric Robertson, they say something like 4.5% on unemployment, 3% core PCE. Let's go. This Fed cuts rates. Don't think the Fed wants to be that specific, that precise about it, but close. It's the conversation we're having. Sam Stovall, CFRA, joining us shortly. Good. GM up in a pre-market with a big capital return program and some customer spending as well. Does Sam Stovall like the auto stocks? That conversation up next.
This period in time on the timeline, this looks like a great time for investors. in equities.
I would definitely still be long treasuries between now and the end of next year, but with a nod to the fact that it will be a choppy ride.
What I find the most concerning about the last month is there's been a massive risk-on rally on weaker economic data.
We are now starting to see lots of different things trickle into the economy, which will make the economy likely fall over next year.
I think it's incredibly important to remain invested even in times of uncertainty.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Typically I would, but I can't even share the conversation, the commercial break.
It's just painful.
Just keep it together, Bramo.
I'm aging.
From New York City this morning.
Always.
Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market is positive by 0.4%. I want to talk about GM, General Motors, in the pre-market. The stock was up by about 5% last time I looked. TK out with an update to the guidance, reinstating guidance, a little bit lower than previous guidance. The stock now up by almost 7%. We've got a big capital return program, Tom, hiking the dividend, $10 billion stock buyback program. And then you've got some cuts to spending in certain areas as well.
I thought Sam Stovall's interview of the day canceled that. The interview of the day is you and Mary Barra here in the 9 o'clock hour. This isn't one announcement. This is a multifaceted primal scream from an underperformer.
Is this a change in strategy or a change in execution?
On a financial side, it's definitely a change in strategy. No question about it. Financially, on the making of automobiles, which is a lousy business, I'm not so sure. I'm not the auto guy.
Two things. There's a really important transition here with EVs and who's going to win that, especially given the preeminence of Asia.
Is anyone winning now besides Tesla?
Certain Asian producers, yes, I would argue. They've actually come out with lower cost models and they have bigger pools of lithium and other types of resources. Then there's a question of the cost of labor in the U.S. and what that is doing to margins and how much that's actually pressuring the need to cut costs. In other words, was the UAW negotiations, as you mentioned, John, the last sort of gasp of labor preeminence in an industry that's increasingly looking to transition into something else.
So you've got new developments, you've got labor negotiations. We're talking about a 25% pay increase, cost of living adjustment, all of that. That's no doubt hung over the stock over the last 12 months in a material way, particularly the last few months. But Tom, it's not just about the last few months, it's about the last 10 years. This stock is almost exactly where it was a decade ago, despite some record numbers when it comes to selling automobiles in this country, TK. How do you turn that around?
Well, you're at 17, 18 million. You got the pandemic in the way will be their excuse. But I think it's a primal financial scream. And Lisa nailed it among 40, 50 headlines. A key one here, I don't have it in front of me, but it's a $2 billion cost reduction, which I'm sure is on top of a previous cost reduction. And if every CFO in the Standard & Poor's 493 has to review this release.
And not just about EVs, also robo-taxis. These bets on the future, Lisa, sometimes they're much, much harder to deliver on. Sometimes you have to find out the hard way that it's going to cost you more. It's going to take longer to realize gains from it. And I think we're finding that out on this particular issue.
Yeah, what happens when a robotaxi just decides to stop right in front of an ambulance and not move? I mean, these are the types of things that they were dealing with, and then they had to have someone come and try to take it away, and the ambulance is thinking, are you kidding me? And these are some of the things that are transpiring.
Again, 72% debt, a lot of that is the equipment leasing, the financing of automobiles. I get that. But this is something that every sell-side analyst outside of autos has to review this transaction and look at analogs over to where their coverage is.
The stock is up by 5, 6, 7% in the pre-market. Right now, we're up by about 6.27% currently. Let's get to the scores more broadly. Equity futures positive by 1/3 on the S&P 500. This rally in the bond market continues. Selective hearing for Treasury investors. Yields down by 3 basis points. Your yield right now, 4.2917. We listen to Waller, we don't listen to Bowman. That seems to be the message from the bond market.
We're listening to disinflation, and I think that is the message that we're getting across the board, and you're getting it. Is it enough? 8 a.m. we get the latest from Germany in terms of headline inflation read. We already got one from Spain earlier this morning, coming in below expectations at 3.2% year over year. I don't want to say this, but I'm going to say this, and then I'm going to get pilloried for it. Is this the easy part? It kind of is in terms of, yes, inflation is coming down year over year. What happens next? The last leg, et cetera.
Sure.
That's, to me, one of the key questions.
It's funny you say it, and I'm sorry to jump in.
No, please.
I thought you were introducing me, just, give me some space.
Sure,
I'm sorry to jump in. Did I say I'm sorry to jump in? I'm sorry to
Where's
jump in.
the surveillance cork?
I've forgotten what I was going to say.
No, you were saying with respect to disinflation. I apologize. 1:45 p.m. we get Cleveland Fed President Loretta Mester, who's going to weigh in on all of this. And then 2 p.m. we get the Beige Book, which we're all going to be reading. The question really is disinflation the last mile. Perhaps that's what you were going to go to. This question of not understanding exactly where we are, how far the fight can go, and when we can call victory.
To parse that is I'm going to give Jim Bianco credit here, the stickiness, the resiliency of a three-handle on inflation versus the two-edness that people like Waller and John Williams of New York are modeling. That, to me, is the forward distinction.
Did I say that I was sorry to jump in? I'm sorry to
You want to jump in right now?
I did know what I wanted to say. It was actually Goldman, and it was Jan Hatzius' outlook. Goldman thinks the hard part is over. That's what I think is so odd about their outlook. And odd, by saying odd, I don't mean I think it's wrong. I just think it's unusual compared to what a lot of other people thought coming into year end. When Sarah House of Wells Fargo talked about the last mile, as you indicated, Lisa, to get inflation back down to 2, from 3, from 4, that was meant to be the hard part. And now you've got Goldman looking out to next year, who basically say all this disinflation is in the pipeline. The hard part is done. And the tailwinds to growth will persist through next year. Not my call, it's theirs. Neil Dutter, as we're talking about this, wrote in, and Neil basically said, this is why, for equity market investors right now, this is soft landing Nevada. You've got Governor Waller basically saying, I need a few more months of this, and we can start talking about cutting rates. And economists on the street can already see what's in the pipeline, and they're basically saying, yeah, you're going to get a few more months of this. I've got no idea what happens beyond that, but you will get it. So the Fed is bound to be engaging in this rate cut conversation, maybe a few months from now, based on what we're seeing in the data.
And that's the reason why if you get cuts in the first half and you get them as soon as the first quarter, as Bill Ackman was saying, how much that fuels risk appetite at the same time.
Sam Stovall joins us right now, Chief Investment Strategist at CFRA. Sam does not have selective hearing. Sam, the bond market does. Governor Bowman, shake it off. Governor Waller, tell me more. Seems to be the approach from yesterday. What did you make of that?
Well, my feeling is that, the interest rates are going to continue to decline on the 10-year yield. I think that they are simply reminding us that high for longer, and I don't say higher because my belief is that the Fed is done raising rates at this point, but high for longer because we don't see it cutting in the second quarter as the street does. We think they'll wait until the third quarter.
Sam, I've got to go here. I talked to Howard Ward yesterday, the giant of Gabelli funds. He's had a terrible year. He's up 41%. Just been really bad. And like Sam Stovall, it's because Howard Ward and Sam Stovall are in the market. And it's been a glorious end to the year. Explain how you stay in the market into next year. Is it use of cash by corporations?
Well, Tom, I like to use stock market history as virtual Valium. And what I try to do is to start by saying, what has traditionally occurred, whether you look to seasonality, whether you look to the presidential cycle, et cetera. And one thing that's incredibly encouraging, but certainly not a guarantee, is that in the election year of first-term presidents, whether they get reelected or not, the market has been higher 100% of the time on a total return basis.
That's not good enough.
Gaining 15.5%. And so, you could buy some options, you could do leverage, et cetera, if you want, Tom, to get that excitement. We were talking about autos a second ago, and I was going to say we have very few buy recommendations around the globe, but Ferrari is one that I would recommend for you.
What about GM, Sam? I mean, this is sort of the key question. Ferrari is one story, and they can hinge off of Formula One, and I can talk about it much worse than my co-anchors who can go further into detail. Just the nuts and bolts of Americana in the car industry. How much can you get behind some of these industries in transition that need to effectuate some pretty big changes in order to adopt the modern kind of framework for their business?
Well, absolutely. Not only do you have to respond to the consumers' changing desires, but also the pressure put on these companies by the government in terms of fuel standards, emissions, et cetera. We are neutral at best on the auto industry globally. We do have some buy recommendations based on the pre-interview discussions you guys were having. I would say for you, Lisa, Hyundai Motor is a 4-star or buy recommendation. For Jonathan, Polestar Automotive out of the UK is a 4-star, but GM is 3, Ford is 3, and a majority of the others are holds as well at this point.
All I can say is, you heard me say that I had a Kia, and all of a sudden it's Hyundai, buy Hyundai. I will just say that. Okay, fine. But I will take this. When you look forward and understand exactly how much we can see a broadening out in U.S. stocks, how much what we have seen so far year to date has just been enthusiasm around artificial intelligence. Where is that coming from? Where is that momentum coming from? Is it coming from rate cuts? Is it coming from the end of the cycle? Is it coming from cash? As Tom was saying, coming out with conviction into the market.
I think it's coming right now from the decline in the 10-year yield, the removal of a lot of the uncertainty surrounding what caused it to move up to and challenge that 5% threshold. When you look at the number of stocks in the 500 in positive territory this year, you're looking at about 60%. Everyone talks about the Magnificent Seven, but we still have 53% more of that are in positive territory. If you're looking at the number of sub-industries in the S&P 1500, right now 84% are above their 10-week or 50-day moving average, and almost 60% are above their 200-day. So there's a lot of participation going on right now.
Sam, I got to make some news here. Are the Magnificent Seven, Standard & Poor's, CFRA, 6-star stocks?
6 stars. That means with extra credit, I guess. I think what it means is that we still do favor the growth side of the equation. We still think that there is value in growth in terms of earnings growth expectations for next year. Also realizing that following up years in the market, you actually want to let your winners ride. Because the top 3 sectors in the prior year, when it's been positive, has outperformed the market on average about 60% of the time in the subsequent year, and the top 10 sub-industries were up average of about 17.9%, outperforming the market about 3 out of every 4 years.
Hey, Sam, great to get the update from you. Sam Stovall there of CFRA. Sam kind of joked about Ferrari. Top of the pile, the absolute king of operating margins, Tom, in the auto sector. It's something like 24, 25%. GM's like a quarter of that.
Yeah, I like it. I mean, you have one, and you know, you can get in it. I can't get in a Ferrari. I mean, I can't fit
too
in.
low down.
It's too low down. I mean,
most people, Tom, have the
right
problem
in.
of not being able to afford one, but I'm pleased that this is what's stopping him, Bramo.
What's
too low down?
How's that working on Lexington Avenue down below 59th Street?
You see much better cars in London than you do in New York City.
Part of it is the potholes aren't too bad.
For obvious reasons. Yeah. If you are just joining us, welcome to the program. Your equity market on the S&P 500 positive by 0.4%. Yields are lower by 3 basis points, 4.2917 on a US 10-year. Big conversation about what's next from the Federal Reserve. We just want to jump from pause to cuts, don't we, Lisa? That's the bias. And everything else is just like, give me some data that supports that view. Give me some views out there that supports my own personal view that they're going to cut soon.
Well, that's basically what we were hearing from Sam Stovall, that yes, you have this openness to rate cuts, and they can see in the market, or you were saying this, that you could see in the market based on Goldman Sachs, that baked into the data, we are going to see that slowing in economic information that will give the Fed the confidence to cut. I guess I have so misunderstood this cycle. I don't understand exactly how housing fits into this. I don't understand the long and variable lags. I don't understand how long consumers can keep spending after we've said month after month they're running out of cash. All of these questions are still looming large.
Right where you went there, the long and variable lag of the pandemic, and I see this percolating. Are we really beyond the stimulus of the pandemic? Tomorrow, personal income, personal spending. I've been so wrong on that. Everybody else has been so wrong on that. The fact, is it going to give us another buoyant tone to what the consumer's doing?
Jobless claims tomorrow as well. Then on to next week. It's Payrolls Friday just around the corner. Just around the corner this morning, big conversation coming up. Howard Marks of Oaktree. That conversation about 45 minutes away from New York City this morning. Good morning.
Increasingly confident that policy is currently well positioned to slow the economy and get inflation back to 2%. Now, that said, there is still significant uncertainty about the pace of future activity, and so I cannot say for sure whether the FOMC has done enough to achieve price stability.
That was worth a 15 basis point move in the front end of the curve yesterday. That was Federal Reserve Governor Christopher Waller speaking to the American Enterprise Institute in Washington. Your 2-year started this week, opened up at 495.91. That was Monday morning. Your 2-year right now, TK, 469, and on the session, down another 4 basis points.
I'm going to watch for a 199 10-year real yield. Bill Ackman, I think, is dead on about this. The real yield is what the adults look at, and the answer is the inflation-adjusted yield from what, John, we're letting out 3.01%, 2.90%, never got there, 2.06% at a 1.99. Do we turn into a pumpkin? I don't know. It's going to be a big deal.
Is that what happens? I thought good things happen when
Cinderella.
No?
Everything's,
Maybe I want to be a pumpkin.
Bramo wants to be a pumpkin. Okay. Scores look like this, TK. No idea where this is going. Often feel that way on this program.
That's okay.
Equities on the S&P positive, Tom, by 0.4%.
We're going to have to see. It's going to be an interesting time and an interesting 2024 for those visible in the public market and, of course, those in the private market as well. Long ago and far away, there was KKR, 1976, with history made in a style and a method at KKR that was original. Shonali Bassett gets an update from their co-CEO. Shonali, good morning.
Thank you, Tom. I'm standing by with the co-CEO of KKR, Scott Nuttall, and it is a really big day for KKR because they are doing this. They're buying the rest of Global Atlantic, a big insurance company that they don't already own. That is an all-cash $2.7 billion deal. But you're also creating a new unit at KKR that houses a core private equity business.
Right.
If you had to give the market one way to understand what you're trying to do over there, what is it?
First of all, Shonali, great to be with you. Thanks for having me. Really what we're trying to do today is lay out the big 3 growth engines we have as a firm. So you're right, we are buying the minority stake in Global Atlantic we don't already own. We already own 63% of the company, so we're buying the other 37%. Global Atlantic has been a great partnership for us. This is a transaction we did in 2021. The company's more than doubled since we announced the original deal in July of 2020. And it's been highly recurring, a lot of growth earnings for KKR. So that's part one. We are also modifying our compensation ratios. So our asset management business continues to scale. Our run rate management fees have doubled over the last 3 years. So the second thing we're doing is reducing the compensation ratio on fees, making an offsetting increase on carry, and that will allow us to create more fee-related earnings for our shareholders.
You're changing the way you pay people.
In effect, not the aggregate amount of compensation, but we're providing more of the fee-related earnings to our shareholders, a little bit more carry to our people. The net of that is about neutral, but it will mean more fee-related earnings overall. And then the third thing we're doing, to your point, and this is relatively new for us, is we're creating a new segment for the firm. So we've historically reported as asset management and insurance. We are adding a new segment called strategic holdings. And what we will include in there are the dividends that we're receiving and will begin to receive in greater magnitude from our core private equity portfolio, which is a portfolio of great, diversified, recession-resistant companies that we've been building up over the last several years.
KKR, Apollo, Brookfield, they're all buying insurance companies. All of you are diversifying in pretty meaningful ways. If you think about it, it's made private equity by the dollars, by the assets under management, a smaller part of all of your businesses. What does this mean for the future of private equity?
Private equity is still a growth business for us. We expect to continue to grow that part of KKR for a long time, both with respect to the flagship strategies, but also we've created a number of different growth strategies. The core private equity business is part of private equity. It's now a $30 billion franchise for us. So this isn't about an or, this is about an and. We see an ability to grow PE and all the other parts of KKR. And we've diversified meaningfully over the course of the last 10 to 15 years. We're just continuing our way down that path.
Now, what does Global Atlantic exactly do? It seems like what it's really doing is giving you a whole balance sheet to be using to compete on. You've mentioned capital markets is one place. There's been a lot of competition from your industry to the banks. How does this help you now compete in a bigger way?
Sure. Global Atlantic, as you know, it's largely issues annuities to individuals. And so if you think about what we do at KKR, we work for pensioners, retirees all around the world, now family offices and individual investors as well. Global Atlantic distributes its products to that same kind of an audience. So historically, we've worked for tens of millions of retirees. We still do, but now they're just in the form of policyholders. And that's our mission at KKR, is to actually do a great job for all those people that we work for. We're not confused about who our bosses are. And so to the second part of your question on capital markets, what Global Atlantic allows us to do is create more synergy. We didn't necessarily see all this 3 years ago when we started our way down this path, but we think there's even more we can do to unlock value between the two companies, and capital markets is just one of those examples.
Capital markets means you might be appearing on more and more deals, lending a balance sheet to provide capital for big buyouts and other leverage loan deals.
That's right, and we're already in that business. So the way that we built our capital markets business is by partnering with the street. So we'll be alongside the traditional banks and investment banks as we built that business. But what Global Atlantic brings us is an ability to expand the vision for that franchise. So there's more to do across asset-based finance, as an example. Or when Global Atlantic does their large institutional block transactions, we can put some on the Global Atlantic balance sheet. GA has its own sidecar third-party capital funds called Ivy, so some can go into those third-party funds, and then we can syndicate the excess through our capital markets franchise as well. Just like we do private equity and infrastructure transactions, it applies to insurance deals as well.
Something interesting about these deals is that you already have told investors this morning that this will add 20% to total operating earnings. You're boosting your targets into 2026 for fee-related earnings. What are the real financial impacts? What can stockholders feel for KKR over the next 2-3 years?
Well, I think what they'll be able to see is we are going to grow all three of our recurring forms of earnings in a much more meaningful way going forward. So fee-related earnings will be higher. We continue to see a lot of organic growth in our businesses. Just by changing our compensation ratios, you get accretion on fee-related earnings. And we think by virtue of what we're announcing today, we can do even more with Global Atlantic, where we invest that portfolio. It's already gone from $72 billion of AUM when we announced the transaction to $158 billion over the last few years. We think we can do even more together. But they'll also see more insurance operating earnings, which we believe are highly recurring and fast growing. And then we'll have this third element, which will be the core private equity dividends showing up in the strategic holdings segment. If you put those three things together, we think that'll be 70% or more of our overall pre-tax income is those three forms of recurring earnings. And we're going to introduce a new metric around that called operating earnings. And we'll talk about that later today with our shareholders.
Scott, we do have to leave it there. Thank you for joining us on a big day over at KKR. Tom?
Shonali Bassick, thank you so much. With the gentleman from KKR and the future of what they do. We're going to go to Apollo. Is it next week?
We are, yeah. Mark Rowan.
Is it next week?
Next week, yeah.
These are big questions, and it's not about deal transactions and the PR of all of it. It's about 2024 and the free-eyed. In the old days, you'd go, so what's your internal rate of return look like? And a guy like David Rubenstein would tell you, and, you know, you'd massage it, or George Roberts and the rest of it. And now they're so much more invested in the economy that I want to know from Apollo what the energy looks like in all their different distress areas.
Well, typically, Tom, I think what we believe private markets is all about is leverage finance, right? And
leverage.
What Mark Rowan and Apollo are really trying to change is to make you think about private markets as everything on a bank balance sheet.
Yeah.
So the total addressable market is so much larger than people realize. Mark has also got this really interesting framework for thinking about markets, Tom, that because of the indexing in public markets,
yes,
that the alpha opportunities in public markets have dwindled, absolutely dwindled. So if you find a stock that's not in the index and you think it's really fairly valued,
right,
undervalued, and you should buy it, what do you do if no one else does? In 6 months, you sell
This
it. And he's saying the opportunities, Tom, in private
deal.
markets for alpha are so much higher. So this is what we've got to talk about next week.
And then the other question is also that with Gensler and the likes of Gary Gensler, how do you regulate private markets? In the old days, it was simple. You had a private memorandum, and either you were an adult and did it or you didn't. Nowadays, the overlap here is extraordinary.
So Jay Clayton, formerly of the SEC, we'll catch up with him at Apollo next week.
I
as
did
well.
not know
So,
that,
yeah,
really.
It's going to be a nice couple of hours to go through some really big issues. You'll be there.
Okay.
You'll be there. I'll come and pick you up. I'll make sure you arrive on time.
That's good.
It's not looking encouraging, is it, Bramo? Not at all.
Am I going to be there?
You'll be there too.
Okay, great.
Okay.
You can pick me up too.
Do I have to dress
Driving
like
the van?
Do I have to dress like a private equity guy? You know,
What does that look like?
No tie.
No tie.
Can't have a tie.
No tie. Cardigan?
Should we go without a tie?
We can go without a tie.
It's good.
Love to see that bow tie.
You can wear a Patagonia thing.
Is that what they wear? pushed out a really small day of gains on the S&P 500. This morning we add to them, up by 0.4% on the S&P. The Nasdaq up by 0.5. Small caps looking good, up by 0.85%. Big conversation about Governor Waller and rate cuts in the bond market. A move yesterday down 15 basis points at the front end.
Look at the 10-year right now.
Tom, look at the 2-year, 469.91. We started the week in the 490s. Big turnaround. We're down about 4 basis points at 469.91. The 10-year, middle of October, I think October 19th, through 5%, back down to 428.98 and down another 3 basis points.
I opened the show with this, John, still above technical support. So the next moves in these yields are really critical to a lower level. Do they breach that support and find a new area on the vicinity of 3%?
So monster bond market rally, yields lower, push it through the FX market. Euro looks like this. The euro against the dollar. Euro strength over the previous 4 days. Bit of weakness this morning. 109.83 is that. At the end of the month, if we basically closed right here, right now, we'd be talking about the best month this year for the euro, Lisa, against a weaker dollar off the back of that bond market move.
And it really has been a weaker dollar move based on those rate cuts that you're talking about. It's also with respect to better than expected data coming out of Europe. But again, the staying power of this. At what point do deeper rate cuts signal something negative rather than just a relief to people who are investing in riskier securities?
Is it negative about the US economy or the global economy? Because that's going to matter a heck of a lot to that dollar call.
It seems like people are looking at the U.S. economy as somewhat divorced. Whether it is put together is going to be a key question, especially since people are betting on the resurgence of China. It's all head spinning. If you're kind of confused listening to me, you're not alone.
Last year on repeat. The resurgence of China.
Yep, pretty much.
Last year on repeat. We've got a great guest on foreign exchange with us, so let's go through some top stories before we get to him. Under surveillance this morning, talks underway to extend the truce between Israel and Hamas as the deal reaches its final 24 hours. Both parties accusing the other of violating the agreement yesterday, but the deal holding as Hamas released 12 more hostages. Secretary of State Antony Blinken will arrive in the area later this week. We mentioned this in a previous hour. I think it's worth going over again. You've got accusations on both sides in the last day, previous 24 hours, Lisa, that either side violated the truce, the framework for this agreement, and yet it holds. Is that encouraging?
It's encouraging that both sides want something specific from this pause in fighting that has not been accomplished yet, whether it's resetting for Hamas troops, Hamas fighters, or whether it's hostages coming back to Israel amid growing pressure. It also signals to me who's pulling the strings here.
True.
There was just a story coming out saying that Saudi Arabia has approached Iran about providing support to them if they pull back their proxy fighters in Hezbollah and Hamas, highlighting Saudi Arabia's desire and Qatar's desire and the United Arab Emirates to have stability in the Middle East and how far they're going to go to try to negotiate that going forward.
And a real awareness of the source of the instability, so to speak, in the region as well. More on those developments around Secretary Blinken's visit throughout this morning on Bloomberg TV and radio. I want to pick up on a single name. General Motors, GM, in the pre-market looks a little something like this, up by more than 9%. We've got a boost to the dividend by 33%. We're announcing a $10 billion share buyback program. GM also reinstating 23 guidance with just a modest cut to income. We'll be catching up with the CEO, Mary Barra, at 9:30 Eastern Time, Tom, on Bloomberg TV and radio.
Without question, the interview of the day. This is a shock to 493 companies that are trying to figure out what to do, what the sea change is for next year. And it's a double barrel here of use of cash and also cost reduction. I'm really interested to see how the big banks swallow this kind of shock.
I said this earlier, Tom, and I think it's the right story to stick on. Is it a change in strategy or just execution? Are we really moving away from some of those investments in tech, Lisa? Are we making that shift away from robo-taxis or just investing less in it?
Or just shifting tactically while they try to improve some of the technology behind it? It's a good question.
Or to compete, as Sam Stovall said, with Hyundai. I mean, to me, the unspoken here is the competitive nature of the non-EV. What's the thing called
hybrids?
robo?
Are you thinking hybrids?
I don't know what I'm thinking. I just think it's a hugely competitive
industry.
robo-taxis
is something else. But
are they competing with Ford? I mean, just as one example.
I mean, trying to.
Yeah, they're trying.
And they're all struggling, competing with each other at the moment. How about this for an investment? Let's get to this story. Tech billionaire Mark Cuban selling his majority stake in the NBA's Dallas Mavericks to Miriam Adelson, the widow of casino magnate Sheldon Adelson, selling $2 billion of stock in Las Vegas Sands in order to complete the deal. The purchase puts the value of the team at $3.5 billion. What did Cuban pay for it? $285 million 23 years ago. Bramo, what an investment.
Honestly, all of the things that I've read about this is, you've reached the top when Mark Cuban gets out. Is he just basically seeing the peak in terms of some of these professional teams and their valuations?
Tim McMahon at ESPN writes it up. It's a 57% Adelson holding. Second sentence of the article, Cuban stays in charge of basketball operations.
It's interesting, isn't it? Yeah.
Small detail. He's not giving it up. I mean, it's. But again, John, to your idea here, the value here, why are people stupid about sports franchises? Because down the road, there's a payout.
He's given up Shark Tank. Just in case you've watched Shark Tank, Tom.
I can honestly say...
16th season coming up, Bramo.
I used to watch it with my kids. I think that it created some monsters.
You're big on Shark Tank? We call it Dragon's Den in the UK.
Really?
Dragon's Den, yeah.
Oh, do they?
It's called Dragon's Den. You guys call it Shark Tank.
I say
we call it.
We.
Yes, I've been here long enough.
Remember that. Yes, come on.
They call it Dragon's Den.
All right.
Okay. Does that help?
Let's go.
He's never been on Shark Tank, but he's agreed to appear with us. Thierry Weissman joins us right now, global FX interest rate strategist, much more than that at Macquarie, with lots and lots of experience on this. I love the first sentence of your note, don't believe the hype. You've been skeptical. Are you combining and dovetailing in with your low rate call a true slowdown in the economy?
Yes, absolutely. I think the narrative these days from Wall Street that I've seen in the last few weeks is that the reason the 10-year yield has been coming down is because we're in a disinflationary phase here in the economy, and there's going to be more disinflation to come in the U.S. I agree with that. We are going to see disinflation in the U.S. It's going to come in rents. It's going to come in those areas of the CPI that are linked to consumer discretionary spending. But let's also keep in mind, one of the reasons we're going to see this disinflation is because the consumer is slowing. And there you have the don't believe the hype story, right? I don't believe the stories about record-breaking Black Friday sales and Cyber Monday sales.
Starts Wednesday, Thursday, whatever.
I think these sales were on the back of heavy discounting. If you look at what some of these corporate execs had said prior to the start of the holiday spending season, they talked about having to cut prices. Walmart even talked about deflation. So this is about disinflation, but let's keep in mind where this disinflation is going to come from. It's going to come from a weakening in pricing power at the consumer product and services level. It's going to be driven by a slowdown in aggregate demand in the U.S.
Also about how they're paying for this stuff. Buy now, pay later. You look at some of the numbers just booming. What do you take away from that?
So
Terry?
my takeaway is from a macroeconomic perspective, what it does is it shifts spending to the early part of the season, because normally you would have to save up a few more shekels as you approach, your deadline on December 25th to get those purchases done. With buy now, pay later, you don't need to do that. So it allows you to spend earlier, especially if you don't have access to revolving credit or credit cards. So I think that's another reason why we might have seen these so-called record-breaking days on last Friday and Monday. But again, if it's the case that spending was only pulled forward, it doesn't mean that in aggregate for the whole of the season we're going to get that much hype.
So far, people have viewed weaker U.S. data as a positive. It's both been for a bond rally and a stock rally, and you're saying that we could see that bond rally continue quite significantly going forward. Will there be a divergence, though, in terms of risk assets? Does there have to be to fuel a bond rally that goes much deeper than where we are now?
Absolutely. To let the bond rally extend to, say, where the 10-year yield gets to 3%, I do think it has to be associated with a sell-off at risk assets. I don't think to get that kind of forceful move early in the bond market, you need to have some sort of dislocation in risk assets, some sort of drop in stocks. But over time, not necessarily. I think we can see a situation where if disinflation continues slowly, you get the bond yield going down to where it was, let's say, in the spring. 3.5% is not inconceivable without a stock market drop, as long as it happens slowly and steadily.
But will corporations adapt? If I go back to Bear Stearns, where you held court, you had an entire security analysis team looking at these slowdowns. I don't buy the gloom in that corporations like General Motors will adapt.
I'm not sure what they're going to adapt to. technological progress and changes they can adapt to. Government policies that spur more investment in electric vehicles and clean energy technologies they can adapt to. But what do you do when you have excess inventory, as the auto dealers do now? What do you do when the banks and the finance companies are cutting off credit to auto buyers? What do you do then? You're not in control of that situation. You're in control of what's happening on your factory floor. You're in control of promotions, and maybe the way you adapt is by cutting prices. Let's face it. That's a way of adapting too, to hold on to market share in the face of excess inventories, in the face of consumers slowing their demand. So yeah, they can adapt, but it's not necessarily in a way that is going to make their stock prices shoot up.
You've identified a series of places in this economy where we could see lower prices. Retail, Walmart. Talked about the automakers. We're talking about GM. Maybe lower prices. Going to see that come through the pipeline soon. What's the biggest threat that still lingers for you? The biggest threat to that view that this disinflation continues through next year?
It's supply shocks. I think the lesson of 2022 and early 2023 was that we cannot control what happens in the rest of the world, especially as it pertains to the supply of oil, the supply of natural gas. So from my perspective, if we get another shock in that market, and by the way, it doesn't have to be because of a war, although in the past 2 years that has been the case. It could be simply that OPEC Plus decides to curtail supply, and we get a Brent going back up to the low 90s as a result of that. Again, it's a question of how much they curtail supply by, but that's the biggest risk right now. The good news is that gasoline prices in the U.S. have been falling for 6 weeks straight, I think, and steadily. I think that's going to show up in the CPI by the time we roll around to seeing the November numbers and the December numbers. But the real reason that the CPI is going to still see disinflation is because rents in the new tenant market and the new lease market are coming down. That's going to put a lot of pressure ultimately on the BLS's measures of rents of primary residences. We're going to get that disinflation over the next few months.
This is exactly what Neil Datta of Renaissance Macro is talking about, Tom. The disinflation that's in the pipeline for rents, for used cars, which is why, based on what Wallace said yesterday, it's not that much of an if for the likes of Terry, for the likes of Neil Datta, which is why they think you're going to get this conversation early next year about reducing interest rates.
Yeah, there's no question there's a school of thought out there that this is not if, it's just simply when and the path to it. But I would dovetail it back to the labor economy, which we've barely touched on today. We've got claims coming up here Thursday, and then you mentioned the late jobs report for November. I believe it's December 8th. But the basic idea here, John, is when does a labor economy finally go? If you get a labor economy to go, you get there instantly.
Claims 209. Keep going back to 209.
Claims 280.
We've been surprised
claims
by this economy in so many different ways over the last 18 months or so. Terry, it's good to see you. Terry Wiseman there of Macquarie. If you are just joining us, welcome to the programme. The state of play, the scores look like this on the equity market. The S&P 500 positive by 0.4%. Yields are lower by 3 basis points. Your 10-year 4.2879. The dollar stronger this morning, but it's dollar weakness this month, Lisa, which catches most people's eyes.
Especially given this ongoing feeling of disinflation. Terry Wiseman mentioned something there, that gasoline prices in the U.S. have been steadily falling for 6 weeks, almost 2 months now. They are currently at the lowest level, average gasoline prices, since January 2nd, just to give you a sense of how far they've fallen. Is this part of what's underpinning some of the disinflation that people feel more extremely? I mean, again, these sort of questions around, have we seen the peak, a complacency around, there isn't going to be another shock due to geopolitics? I don't know. This, to me, is kind of a sort of sleeper issue.
Well, we got the supply shock.
Exactly.
At least we thought we did. And then it didn't happen. Crude ends September, Tom, in 90-something, in the 90s, back down to 77. We had a drop of more than 10% in October, and a drop again in November.
And the Bloomberg Commodity Index, even with orange juice and cocoa and all that taking off, I mean, the bottom line is there's a disinflation there of some form, and linked into China. I mean, I get that.
I know you've been looking forward to this conversation all morning, Tom. In just a moment, Doug Cass of Seabreeze Partners on the life and on the legacy of the late Charlie Munger. TK, that conversation 5 minutes away.
Can't wait for it. And to follow on to that with Howard Marks. Terry Weissman, Doug Cass, and Howard Marks. That's what surveillance is about.
Back to back on Bloomberg Surveillance, live on TV and radio over the next 30 minutes or so. From New York City this morning, your equity market positive by 0.4%. Good morning.
That's the nature of good enterprises, that they know how to accept change, even a sudden unexpected change, and go on quite creditably. And that's exactly what will happen at Berkshire.
The former Berkshire Hathaway vice chairman, Charlie Munger, speaking to Bloomberg back in 2011. Charlie Munger died yesterday at the age of 99. TK, ever since yesterday afternoon, around the market close actually, the tributes just started to flow in.
Yeah, it reminds me of John Templeton's passing and the great Phil Correa at Pioneer as well. We are thrilled to bring you Howard Marks. He'll be coming up. He specifically wants to talk about Mr. Munger. And right now, and this, I can't say what an honor this is. 10 years ago, he was a designated piñata. Doug Cass was the ultimate short panelist at the meeting of Berkshire Hathaway and lit up the investment world with a sharp conversation. Thrilled that he could join us today from Florida. Doug, what did Charlie Munger mean for Warren Buffett?
That's a great question. But first, let me say, Bramo, John, and Thomas, or as we call you in our household, Tinkers to Evers to Chance. It's great to be honoring Charlie, and Tom can explain the Chicago Cubs double play. This was a beautiful friendship, an exquisite love story, far more complicated than Ryan O'Neal and Ally McGraw in the movie of the same name. It was a 6 decade in the making of two great friends and investment, a melding of two great friends and investment minds, arguably two of the greatest investors of all time. He was a compendium of reason and value, and to many of us value investors, like my friend Howard Marks is coming up, we worshiped at his altar. Warren Buffett held his tongue a lot, but Charlie could be prickly and almost defiant. They were both very blunt and both very brilliant. I think that Charlie was far more, in terms of cerebellum, intelligent than Warren. He graduated Caltech and had a law degree from Harvard. He considered himself the smartest man in the room, and guess what? He was. He didn't suffer fools lightly. He had no patience for idiots and told those people they were idiots. In terms of the question I think you're leading to, what are the consequences for Berkshire Hathaway? There already has been a line of succession established, and Charlie Munger inadvertently mentioned it in the Berkshire annual meeting in 2021. When he said that Greg Abel would become the chief executive once Buffett is no longer in charge.
Doug,
but this is a big personal loss to Warren.
Sure.
He's lost his confidant. He's lost his best friend. Charlie, long ago, embedded the idea. This is the most important thing that he gave to Warren. He embedded the idea of quality and concentration with Charlie, preferring to buy a wonderful company at a fair price over a poor company at an attractive price. Remember that Warren initially bought broken companies, or cigar butts, as he called them, in the early days. But he changed with Charlie on the scene.
Right. I want to get this in, Doug Cass. I think it's so important. When you were at Kidder Peabody down the hall from Julian Robertson, you and I would wait for the annual report of these two guys. Explain to our younger audience worldwide what was so special about that Berkshire Hathaway simple printed annual report. The only proxy I have now is Jamie Dimon's note.
My annual reports are dog-eared. I've literally read each one over 50 times, and I'm not being hyperbolic. The value in them was the wit in the sayings, and Charlie had some of the best sayings. One of those was, if I can be optimistic when I'm nearly dead, certainly you can accept a little inflation. Or to say derivative accounting is a sewer is an insult to sewerage. Or as you tweeted out, every time you hear EBITDA, just substitute it with BS earnings.
I look at this, Doug Cass, and let's go back 10 years. You were the piñata, you were the short seller, the gloomy guy at the meeting. When you and Munger battled at that 2013 meeting, how many hits did you take?
I took a bad hit in my most important question. Warren wanted to do something different. Never in the history of annual meetings has a short seller who short the company's stock been invited to ask hard-hitting and hopefully respectful and tactful questions. So I sat in the dais next to them, and the question I asked is, would you consider giving $200 million to me to manage a short portfolio? And that if after 2 years I failed to outperform Berkshire's portfolio, I would return the investment fees back to Berkshire. Well, his response to me was pure Charlie Munger. He said with regard to his unwillingness to sell short stocks that he doesn't like trading agony for money. It's just brilliant.
Do you notice that Cass is cut and chiseled? I mean, he's not been out on the golf course.
He has told me a few times he's on Ozempic, 50 pounds
it's
lighter.
It's like a new Doug Cass that we're seeing.
We can
here.
perhaps get into that in just a moment.
Yeah.
Doug, I just want to explore investing approach just a little further with you. You referenced that quote, and I'll share it again. Far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Charlie understood this early. I was a slow learner. Doug, can you talk about the evolution of their approach to markets, particularly in the last, say, decade or so, given the explosive nature of indexing and just buying the S&P 500? How have things changed for them, Doug?
That's a great question, and it's an essay answer, but I'll try to be brief. He used to try to buy gazelles, John, that were in trouble, whether it was American Express in the oil scandal or Geico was on its deathbed and trading at $1 a share. Because of Charlie, he started buying companies like Chicago Pneumatic and Lubrizol, Heinz, quality companies. He would pay up for those companies. I wrote and discussed in one of my questions, he was searching for gazelles in the old days, but he was buying at hefty prices consumer product companies that he was comfortable with. I think he was protecting Berkshire Hathaway and making them morph into something that resembled an S&P index fund. And I think that was his legacy, Jonathan. Impenetrable moats, impenetrable suite of products and companies.
Doug, it's fantastic to get your thoughts this morning. We all do appreciate it. TK referenced, of course, Ozempic. I think maybe we can finish on that. Doug, we were talking about how life-changing that might be for this economy, to approaches to markets. Can you speak to that personally, Doug? Just have you changed your investments off the back of your personal experience with this?
I do own Lilly. And I have said that for now, AI is an elegant parlor game, and that Ozempic will have, in the next 3 to 5 years, a much more profound impact upon our economy than AI.
Any thoughts on where you think that impact will be most profound, Doug?
Lower insurance costs, most importantly, I would say.
Doug Cass.
And I think this is one area where you can get partisanship in Washington, D.C.
Interesting.
He says that with a smile at the end there, TK.
He did.
I think we can agree on that. Hey, Doug, fantastic to get your thoughts on the legacy of the late Charlie Munger. Doug, thank you. Doug Cass there of Seabreeze Partners. That approach to markets, Tom, had to change. Had to change because the way everyone approached markets had to change. It
hasn't. In the time of the Magnificent Seven, I mean, it's been a shock. Doug's been an Apple bull for years within his short selling and the times he's been off. And, you know, as any short seller here, you see Jim Chanos shutting down. It's been a sporting 2023 for that crew. But what's timeless here and what's sobering into 2024 is the idea of what do you do with quality when it's so narrow. That, to me, is fascinating.
And understanding what quality is. I mean, you think about Warren Buffett's first company and his adjustment to this sort of buy a wonderful company at a fair price. It was See's Candies, right? It was something that he liked the candy, and he paid a price for it that he wouldn't previously have paid, and it delivered him $2 billion in profits over the tenure of his experience. It isn't tech. It isn't Ozempic. It was See's Candies. I think that's really interesting. How has that changed with different, trends, et cetera? But that, to me, is interesting.
As the great Peter Lynch would say, I was so honored that Peter Lynch joined me the day of John Templeton's death. If you have to explain what it is, that's a bad start. I'm sorry. Apple, they sell phones. That's, I think, what they do.
One thing has changed, though, in a big way, and Doug alluded to it just there. The benefits of being that concentrated pool of capital that you can dial on in an emergency, 1-800-Berkshire. Saw that in the financial crisis. Yeah. The Federal Reserve response time to the pandemic kind of changed the game a bit, Bram, on that front, didn't it?
They took the front seat on that front. They didn't need to go to Warren Buffett to get his cash.
All that cash was there on the sidelines, and that window was like this big. Last a few months. Coming up on the Open next hour on Bloomberg TV, Richard Bernstein Advisors, Bob Dollar, Crossmark, Sarah Hunt of Alpine Saxon Woods, and the GM CEO, Mary Barra.
Central banks are going to cut regardless of kind of the setup for next year.
We'd expect to see something like 150 basis points of cuts from the Fed next year.
There is a potential for the Fed to make it all the way to the fourth quarter of next year without having to cut.
It's very hard for them to look forward 6-9 months and feel confident that inflation is going to be at their targeted level.
People are very quick to think that things are over when they take time to actually get through the system.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Markets up, yields down. Really an extraordinary day. Lisa and I will dive into that. John Ferro on sabbatical here for the next 60 minutes. But what we've got is markets on the move, and also, of course, the death of Charlie Munger. What a joy to have Doug Cass with us here moments ago. Howard Marks coming up momentarily. Mr. Marks, on the life of Charlie Munger, the impact he had on all of us, including Oaktree and the rest. Let us turn to the markets right now, and what I would say in the last hour, maybe off the GM bombshell, a furtherance of the good feeling that started yesterday.
And how much is this also piggybacking on the concept of disinflation? This just crossing the German preliminary CPI coming out below expectations at 2.3% versus the expectation for inflation coming in annualized at 2.5%. This is part of what's driving the good feeling. Disinflation without a disproportionate amount of pain. Is it just sort of the illusion of a soft landing before something else? Or is this exactly what people had been expecting? And that, I think, is really one of the big questions heading into next year.
We'll do the data check here in a moment, but Russell 2000 on a November basis breaking out to up 1%, showing the good feeling. SPX up 0.5%. And what it comes down to is the Waller shift. We've talked about that through the morning. But much more for me is the Barra shift. John's going to be speaking with Mari Barra in the 9 o'clock hour. And I'm sorry, this is not a mundane press release from GM today.
Talking about some cost cuts as well as dividends and share buybacks. There is a question here about how difficult it is to parse through a market and understand valuations at a time of industries very much in flux. I think about with the auto industry. I think about that with the tech industry. And then I think about it with small businesses, mom and pop shops that are trying to compete with inflation and benchmark costs. This is the reason why I think it's actually really important for us to be talking about Charlie Munger, who lived through a couple of sea changes in the concepts of investing and how to value companies and what it means to have a wonderful company and what it means to have fair value.
And what's important about this, we'll talk to Mr. Marks about it, I'll frame it then, folks, is that Charlie Munger, to me, was formed off of double-digit losses in the 73-74 bloodbath. It was really ugly, and that steeled him for the fundamental analysis he did into the future. I haven't asked you this in ages, and it's germane to where we are right now. The 10-year yield, 4.29%, a little bit lower earlier. 5-year crescendo's down to, 2-year rather, crescendo's down to 4.67%. Futures up 22. The VIX is stunning, sub 13. What does the spread market signal? I mean, you know, Howard Marks has got 4 Bloomberg. Howard Marks has 20 Bloomberg screens in his study. And he's got them all distressed out. What does the spread market say, oh wise one?
Well, I know that Howard Marks probably looks at the balance sheets more closely than public market marks. There is a question we can ask him himself. But really, to me, the question is whether we are seeing complacency bleed into public markets. Private markets, a different story. But public markets, a lot of people talking about how they really are not reacting to the slowdown in consumers, in the likelihood of a higher for longer type of regime. And they're just pricing in the Goldilocks that equities are. Well,
the Goldilocks maybe that 7 stocks are is, well, we're going to wander through a group data check here right now. Can you give me General Motors, Amy, when you can? General Motors with a big pop here off what we've seen with futures up 22, the 10-year yield 4.29%, oil up maybe $1 or all. Watching gold, I mentioned Dennis Gartman yesterday, gold in yen, one of of the great trades of a generation. It's to the moon. It's a moonshot up with gold well over 2,000. And General Motors up 8% as well. Every CFO of the 493 lost stocks have to review this strategy this morning.
And where they're going to cut costs and how they can invest to compete, not least of which with China.
Yeah, it's going to be interesting to see. I think of days as to the death of John Templeton and what surveillance did, and we do this today with Charlie Munger. We had Terry Weissman on. Great to have Sam Stovall on. And Doug Cass with his intimate relationship with Berkshire Hathaway. We finished strong with Howard Marks, chairman of Oak Tree Capital Management, and I must point out, author of not one, two, but three important books on investing, of what to do, and just as importantly, Howard, what not to do. Howard, on Charlie Munger, getting the odds on your side, how did Charlie Munger get the odds on his side?
He started off with a brilliant mind and a brilliant partner. He intensively studied the financials, thinking about the long term. He never tried to guess what a company or a stock would do in the short term, and he held for many years. He was a great practitioner of sit on your hands, and he did it flawlessly.
In the modern day and the modern media, I remember reading those annual reports, Howard, years ago. There was no financial media. There was no blogging internet. The short-termism we're living it now. What is the lesson of Charlie Munger's long-termism?
Well, if you want to hit the long ball, you have to be very patient. And, when the stock moves up the first 20%, you can't start taking profits. Charlie and Warren have held things for decades. And the other thing is and Charlie always talked about this, you have very few moonshots. Charlie said within the last year that most of his wealth came from 4 decisions. And what would have happened if he would have started trimming those 4 decisions early? He certainly would not have accomplished what he did. And I think Warren would say the same thing. Maybe the number 4 would be a little different with Warren. But, Warren's famous for having said, put all your eggs in one basket. And I watched the basket really closely. And I think that it wasn't one basket, but the idea of concentration and patience, coupled with good decisions, makes for a great success. A concentration and patience don't accomplish anything if you can't make above average investment decisions. But putting it all together is the formula for success.
Howard, you wrote in some of your thoughts about Charlie Munger that he had very definite opinions, in particular regarding the investment management industry. He viewed the industry with considerable skepticism, and while a member of it, I found myself in agreement with him more often than not. What exactly are you talking about in particular?
I think both Charlie and Warren felt that our industry, relatively few members of it, made substantial contributions to their clients' wealth. Many more members were well paid. He was always one who questioned incentives. He says, "You give me an incentive, I'll tell you the behavior." And I think that I think that Warren and Charlie viewed their operation. In fact, Warren said in quotes, not a partnership, not a corporation of partnership. And they considered the people they manage money for, their shareholders, to be their partners. And they considered themselves to be working for their partners and not themselves. And their own wealth and success was a byproduct of doing great work for the partners. So, I like to put myself in the same boat. Those sentiments appeal to me greatly, and I've tried to follow that.
How difficult has it been to adapt the strategy to different eras? When you had conversations with Charlie Munger, there were questions around tech and how that changed the investment thesis. How did they think about the changing concept of what a wonderful company looked like and what fair value was?
On the one hand, you have to evolve with the times. On the other hand, they never went full bore into the tech sector. They're famous for having made a lot of money with Apple, but most tech, the way they said it, they put it on the too hard pile. And if you understand that your success will come from a small number of holdings, that means you don't need 20, right. 30, 40, 50, 60. You don't need to exploit all the sectors. You just have to find a few great ones. Of course, on the other hand, Tom said that we're in a new era with all the communications we have. Part of what that means is that the world is a more interconnected, intelligent place. Back 50 years ago, we used to be able to exploit things nobody else knew. Today, there's very little information that doesn't make its way speedily around the world.
Howard, help us with one final question here to the future management of Berkshire Hathaway. They have from COVID buildup of cash of $412 billion out to $500 billion, $525 trillion. You and everybody else out there is living with explosive money market fund growth. You know the story in that. Forward here for Berkshire Hathaway, what's the best use of their and our mounds of cash?
The people who run Berkshire today and will run it tomorrow understand the limitations of size. All things being equal, size makes it harder to outperform. They have the best probability of outperforming of any company their size, but their size will matter. And, one of my professors at University of Chicago, I asked him afterwards, how would you manage a big fund? He'd say, I would index the core and manage the hell out of the periphery. And I would imagine that at their size, they'll have to move in the direction of something like that, although they will not give up on outperformance.
Howard Marks, thank you, with Oak Tree Capital Management in remembrance of Charlie Munger.
Tom and Lisa, thank you for having me on at this important moment.
Thank you so much, Howard.
Mr. Marks, thank you so much. And I look, Lisa, here at all of this, and it reminds me of the death of John Templeton when Abby Joseph Cohen and Peter Lynch and others stepped up. And the common theme here is the short-termism of financial media that you, I, and John and Paul Sweeney have fought for years. There's got to be a long-term perspective, particularly when you look at the failure of the American retirement system. Yeah, it's going to be interesting to see. Quickly here, we got to look at the data here. Standard & Poor's 500 up 0.5%.
When you talk about the short-termism, I wonder if Charlie Munger were growing up in today's market, if private markets would have a very different kind of environment than public markets, simply because of the indexing, of the difficulty to value in real time.
Howard alluded to that, and I strongly agree. The methodologies, the hagiography we do of what used to be is not replicable today. It's a different world here today. I mean, it's just as basic as, does the market close at 4 or does it close at 12 noon because we all have cell phones now? It's a whole, I mean, even the daily rhythm of the market has changed, let alone fundamental investment.
One thing that Howard Marks said that I thought was really important was the idea of size and how size has shifted a lot of different investment firms, and how at a certain point you have to be the index if you are the index in your size, and then you just have a slice where you try to make not necessarily moonshots, but really good bets. And that seems to be what we keep hearing, and it raises a question of whether the outperformance might be in the smaller funds, but they can't necessarily amass the critical.
Ferro, as a joke, keeps a clock on Apple earnings when I explode about the lousy reporting on it. When you get to that size, you manage for profit. You don't manage for revenue growth because it doesn't move the needle. Right. You manage for profit, which is what we see with certain selected companies, including in Cupertino. Thanks to our team. This has been fabulous on Charlie Munger. Good morning.
I think any part of the business can be made more efficient. Even the areas when you're growing, you can still look at how do I grow efficiently. One of the things I always tell the team is, I want you to be scrappy. Pretend it's your own money and it's your last dollar. How are you going to spend it? And getting that kind of creativity, I think that's when people do their best work.
The engineer, the chief executive officer of General Motors, Mary Barra. This is going to be important. Please stay with us on Bloomberg Television and Radio in the 9 o'clock hour. What do you think, Lisa, here? Like within the hour? Maybe 55 minutes. Ferro's in charge of that clock. Mary Barra.
9:30 at the Market Open. We'll see.
Grilled by John Ferro. Grilled, I say, by John Ferro. Mary Barra, that's an important conversation coming up. Right now, we get a pre-brief with someone qualified. David Welch is Detroit bureau chief. He knows it is the Detroit International Auto Show, and he joins us this morning. To me, it was the set of announcements. David, let us start with the cost cutting. Can you do use of cash because you're going to pare the budget to the bone at General Motors?
Look, in a way, they're forced to do a lot of cost cuts because the new labor contract is going to cost them an additional $9 billion over the 4 years and 8 months of the contracts. They've got to find other places to cut if they're going to keep profits going, because their plans to double revenue by 2030 to $280 billion. They're actually growing revenue this year. I reported a week ago they're on pace for a 12% gain in revenue despite the strike, but all this new market share from EVs and from autonomous vehicle ride-hailing sales with the troubles of having a cruise, a lot of these technology plans are kind of stuck in second gear. So they've got to find a way to boost profits, and cutting costs and maybe selling some more expensive internal combustion vehicles is the way they're going to do it.
Is this pressure from the CEO, Mr. Ferro will speak to her in the hour, or is this the board pressure, or is it outside visible or less visible activist pressure?
We don't know if there's an activist in there. I think, well, so far no one's stepped up. I think the threat of that is there. I think the board's aware of that. Look, the share price is down 12%, 14% this year. It's lower than when Mary Barra took over. It's lower than the IPO of 2011. None of that is good. Now, look, the street doesn't really like legacy auto companies. They haven't really given any of them much love because they see this internal combustion business as a long-term decline, and none of them have been able to successfully sell electric vehicles to show that they can stay in the game. So companies or investors are sort of ignoring these companies. So GM does generate a lot of cash. That's the one thing they do very well. Under Mary Barra, they've had record profits, record cash flow. So their way of luring investors in is by returning some of that to the market.
David, can I just parse through some of what you just said? There's a question of what the connection is to now versus, say, 3 months ago. How much is GM trying to piggyback off the new contract with workers and say, look, if we've got higher costs, we have to cut elsewhere, we have to become more efficient? How much is that part of the narrative?
It's a lot of it because, look, among the various things that were weighing on the stock over the past year, the labor contract is certainly one of them. Even before the strike got ugly, the rhetoric got nasty, the market knew that it was going to be an expensive deal because the last couple of labor contracts were relatively cheap for all of the car companies. And with record sales, record profits over the past few years, the union was really kind of sharpening the knives and saying they were going to go to the mats on this, and they did. So a lot of that was built in. And inside GM, there's a lot of talk about having to do things more efficiently, find new ways to engineer and build vehicles that reduces fixed costs because their variable costs, namely labor, has gone up significantly.
David, how much is this an excuse for the larger picture that you're talking about, which is namely competition from China? We've heard this very directly from some of the European car makers. How much is that really the main overhang that's leading some of these companies to say, let's monetize what we've got? Yes, maybe some of the combustible engines are not going to be for the long term, but right now we're not competing with the likes of some of what's coming out of China, out of Korea, out of Japan.
It's a really tough time right now to be running any of these old car companies because you've got Tesla stealing the luxury market and being the real growth company. You've got this threat of companies from China coming, so I think you're right. That's a very big piece of it. And then meanwhile, they've got higher costs and they're struggling to get out of the starting blocks with their own electric vehicles. Really, other than generating cash, a lot of what's going on with these companies just isn't really working right now. So this is the one thing they can do to keep investors happy, and I think their board's aware of that.
David, I saw an inventory chart. I was shocked at the Stellantis inventory. Speaking as an amateur, you're the pro here. Tell us about inventories into the brutal winter months. Is it going to be everything on sale?
We haven't seen that yet, but I think as interest rates really have kind of eaten into consumer confidence and also just raised the monthly payments for vehicles, which were already really high. It's already well over $700 a month is the payment for a new vehicle. I think you're going to have to see some incentives come in to offset the interest rate effect, just for starters. And look, interest rates have an impact on the economy, right, Tom? I mean, they slow activity down. It's economics 101, and it's what the Fed wants to see happen so they can bring prices down. Vehicle prices are still at historically high levels, even though they've come down a bit.
David Welch, as a pro, goes right to the heart of it. $700 a month. David Welch is shopping new cars in Detroit for Bloomberg, driving all of our coverage. They are a bombshell. Mari Barra coming up. Again, I can't say enough about this. John Ferro in conversation with the engineer from the General Motors Institute, the chief executive officer of the General Motors Corporation. The legacy of this, I can't say enough, Lisa, about the legacy of this that David touched upon. And there was the key phrase, Wall Street has ignored the auto companies. I find this, and this is Tesla an auto company or not? I don't want to get in that debate right now. But the base, I think of Ite, my colleague, and I mentioned him earlier, the Uber bull on GM. He's been right about market share this, pickup trucks that, but has the stock been there? And the answer is no.
And we've seen this since really 2009, right after that became a real focal point of the bailout and all that. I will say this. One of the questions that I have is how much are some of the auto manufacturers in the U.S. ratcheting back expectations because of auto loan rates and the increasing delinquencies. Just want to point this out from the latest data from the New York Fed showing that the average rejection rate for auto loans reached 11% in the latest read. That is the highest in a series going back to 2013.
And it's what does it cost to get into? And we're all hardwired for $2-something a month, $300 a month, unless you're driving something fancy. But, they price themselves out of the American market. It comes into used cars, and even in used cars, with the slowdown, you have true disinflation in the price of used cars. And to the inventory chart, I don't have it in front of me, folks, but it's real simple. I guess Ford and GM doing better than Stellantis, Chrysler. I still can't get used to the word Stellantis, Dodge Ram, and that kind of thing. And then there's others as well. And it just seems to be, as a general statement into the winter, a lot of cars out there.
Especially as you see delinquencies, in particular younger borrowers who are borrowing to buy cars really creep up to before what we saw during the pandemic. I mean, this is actually exceeding that by a significant margin. So again, I mean, do we start to see the disinflation there, or do they just reduce production enough that you end up with sticky prices despite just lower volumes?
On a Tuesday, near the end of the month, I will say for the first time, folks, what I haven't said in ages. Bloomberg Surveillance is on a record high watch for the NASDAQ 100. Russell 2000 up 1.1%, NASDAQ 100 futures 16,155, which is below that 16,573 record high, but now we're within reach.
And fueled, I would say, in significant part by the rally that we've seen in the bond market with the expectation of rate cuts. I will just say this, coming out from Andrew Hollenhorst of Citigroup moments ago, pushing back a little bit against sort of the rate cutting enthusiasm that we've seen, saying, we continue to think these, quote, normalization cuts are more a theoretical possibility than a likely outcome. The Fed is likely to wait until the economy is more clearly entering recession before cutting rates. And it goes to this question of what's the threshold to actually make that move. We're going to be listening for that from some of the market speakers, from some of the Fed speakers ahead of the quiet period.
Second look, third quarter GDP with a 5% statistic on it. Interesting to see the makeup of that, the GDP price index. And then, claims on the 30th of the month, tomorrow rather. Claims coming out here will be extraordinary. I mean, continuing claims and also initial jobless claims, 218,000. I think that used to be called fully employed America is where I would put that. Stay with us. Much more coming up on the American economy. Laura Ram, FS Investments. Bloomberg Surveillance, good morning to all of you on radio, on television, worldwide. Radio, CarPlay. Do you have CarPlay?
I'm going to get it. I'm going to try to adapt to the modern era. Do you have CarPlay? Do you have a car?
No, do I? No, the driver has one. You know, he puts the button, opens the window, and says, "Would you like your CarPlay, Mr. Keene?" And you know, I say yes.
Cigar.
Carol Massar in the afternoon. You know, it works out. Good morning to all of you. We have economic data. We're going to get to it in a minute, but some eventful work yesterday. Bond market driving equities higher, up 23 points. Lisa, please.
Well, you just want to point this out. Right now, Fed swap contracts are pricing in a full quarter-point rate cut by May, and you've seen that in yields that are keep coming in, 428.59 now on the 10-year. So as you had these bets on Fed rate cuts for next year, Fed Governor Chris Waller telling an event in Washington yesterday that he's encouraged by the recent economic activity.
I am increasingly confident that policy is currently well positioned to slow the economy and get inflation back to 2%.
Meanwhile, fellow Governor Michelle Bowman leaving the door open for further rate hikes at a speech in Salt Lake City. Maybe nobody listening, but this is what she said, quote, "I remain willing to support raising the federal funds rate at a future meeting should the incoming data indicate that progress on inflation has stalled or is insufficient to bring inflation down to 2% in a timely way." This ahead of 2 p.m. today, the Fed Beige Book release. That's going to be coming out. And Fed Chair Jay Powell speaking in Atlanta tomorrow. I do think it's interesting that people were listening to Michelle Bowman and like, yeah. Basically, that's what you got to say at this point to create at least a vision that there's some options here. Bloomberg's Michael McKee joining us. What did you make of that? The fact that markets really keyed in with Chris Waller and completely ignored Michelle Bowman.
It's because Michelle Bowman was suggesting what they want to hear, that we might not need to see additional rate increases. Chris Waller getting some support from the GDP numbers just out this morning.
Am I right? Shocking?
Shocking, yeah, in a way. Third quarter GDP revised up to 5.2% from 4.9%. That's well above the 5% that was thought. And a lot of that comes from increased business investment, which came in pretty low in the initial report. And so that was a bit of a surprise, but we're seeing a little bit more non-fixed, non-residential investment. The GDP in terms of personal consumption, however, is lower. We spent less, 3.6% compared to 4%. Lisa's refrigerator will show up in the fourth quarter, I think.
Yeah, this is true.
And the GDP price indexes, which the Fed doesn't really pay attention to because they're quarterly averages, come in lower than anticipated. The quarter-over-quarter PCE price index, the core, comes in at 2.3% compared to 2.4%. Now, we'll look tomorrow to the PCE numbers to see whether we get the same sort of thing. Trade deficit widens. The advanced good trade balance for October, $89.8 billion from $86.9 billion. So that's a little bit of a subtraction off of the first month of the fourth quarter. And then inventories come in weaker, down 0.2% on the wholesale level and flat on the retail level. That is less than what had been anticipated. There's your roundup of Chris Waller news.
Well, let me look at the market here with the lift here. The futures up were 22, now up 24, 0.5% on SPX futures. Dow up 133. The VIX gets love, 12.58, a lower quiescent VIX. Russell 2000 up 1.2%, shows the effect here. And Lisa would say, yeah, it's bonds in 4 basis points, 4.2827% here. Mike McKee, I got to go right to tomorrow's data before we go to Laura Rahm. And the basic idea here is no one's talking about the job market. What if we get another glorious jobless claims, say under 220? I mean, it confirms a fully employed America, right?
Well, it would probably mean for market participants that they're going to keep their bets right now that the Fed will start cutting rates by the mid part of next year. Nobody seems to be buying into the Bill Ackman argument yet of the first quarter. But it's a week from Friday that we really care about in terms of jobs. And it'll be interesting because we're in the quiet period then. And then we also get CPI just before the Fed meeting. So two of the biggest data releases come in the quiet period. We'll see if they support the Waller view that the economy is slowing enough to bring inflation down. That'll be the key thing. Tom, I would point out, I know you're a nominal kind of guy.
Yeah.
Nominal GDP for the third quarter, the second estimate, 8.9%. I knew I'd think it.
You get me going on this. We're going to go to Laura Rahm. I was guessing 8.1%, and I figured you'd say 7.8%. Did you say 8.9%?
I said 8.9%.
Absolutely stunning. Michael McKee knows how to make me speechless. John Ferro would say, well, that's a good thing. Joining us now, Laura Rahm, Chief U.S. Economist at FS Investments, on an 8.9% nominal GDP America. Laura, what's so great about your economics is you've got it from the litmus paper of the FX market. How alone is the United States with an 8.9% nominal GDP when Rishi Sunak is telling Francine Lacroix he's worried about austerity?
I think we are still, the growth continues to just surprise to the upside. And to me, it's remarkable the inconsistency between talking about rate cuts to, this idea that we're going to need rate cuts in the near term to support the economy, or this short-term idea that we've seen the labor market slow, when really we do feel like we're an economy, and the data would show that we're an economy firing on all cylinders. Government, business spending, consumption. The only piece that's not really adding to it is residential construction. I would say that we are the standalone leader on growth.
And what's so important here, Lisa, nominal GDP top line, that's real GDP plus inflation, is there's an assumption here by the Bill Ackmans of the world, economists and not, that it's going to plunge down to what, 6%, 5%. Even that's a boom economy.
And when you say it, they're talking the inflation component. And Laura, that's what I want you to weigh in on. How much does it matter if we see a slowdown? Do we need a slowdown if we continue to see the pace of disinflation that we've seen so far this year?
I think there's two pieces to that argument. To me, the real, and one place where I'm probably off consensus, is I am really reticent to think that we are going to get this magical slowdown in inflation back to that 2% lane that we have had. On the good side, we have a lot of indications that just from some slower demand and from some of these resolutions in inventory that we're going to see lower goods prices. But I think we are really ignoring the big elephant in the room, which is services. We still have a hot labor market by my measure. We still have wage pressure that is way higher than prior to the pandemic. And the resting heart rate of inflation is still well above 2%. And on the services side really is the problem here. So I think we need to be careful about being very complacent about inflation coming down. And that really feeds into this non-recessionary rate decline, Goldilocks complacency that has taken hold of equity markets at this moment.
In some ways, the Fed's Waller really kind of fed into that yesterday, which is the reason why maybe he gave steam to some of these market movements. He said there is just no reason to say you would keep rates really high and inflation is back at target. How high is the threshold then to cut rates? If we do see the disinflation in the pipeline significant, it might not be long lasting because of some of these other issues, but we do see year over year comps come in with auto price disinflation or outright deflation, with rents coming in, with the fact that goods, as Walmart said, just prices are actually going down outright.
I think the Fed is good at looking around the corner on especially this rent issue. There's no doubt that rent is a very lagging indicator, but it's sticky for a reason. And all of the short-term indicators that 6 months ago were really pointing to rents coming down fast have now reversed. And I think something that's very important to me is the fact that rents are far below the cost that it is to buy a home per square foot. It's costing you a lot less to rent. And landlords are rational. They're going to see this, and they are going to, over the next several quarters, push rents higher again. So it's something that you just can't ignore in the core, even if you get the headline hitting 2%. I get nervous when the Fed tries to micromanage the inflation process.
Laura, and this, with your overarching philosophy of summing all this together, are we beyond the pandemic? It sure doesn't feel like it to me. It feels like the stimulus is still popping. But from where you sit, are we beyond COVID?
Not in the data, Tom. I think we're seeing this trampoline effect, and the Q3 GDP numbers are a great example of that. And we had a big inventory, push higher. We could very well get that still detracting from the fourth quarter. You're still getting some of these big swings in factors that are disguising what's going on underneath with demand, which is still really red hot. So this is a big, to me, piece that we're looking at for 2024. We start to see some move away from reliance on savings. towards income. I think the irony is it could be a period of lower growth next year, but actually better sentiment about household economics as you see income finally catch up to the prior year and a half of inflation.
Okay, I'm going to pin you down here. Give me some 2024 Laura Rahm outlook numbers. Real GDP, what do you think?
Real GDP 1.4. And I think the 10-year stays pretty high. I'm putting it at 4% for 2024.
I mean, Lisa, these are huge slowdown numbers. And then the question comes over immediately, what does non-farm payrolls do? David Kelly at JP Morgan would say it goes negative.
Well, and this is really the ultimate question, Laura. Do we get that kind of slow growth but high yield along with a fully employed America, along with job creation that continues to chug along?
I think that we look at the recessions that we've had in the 2000s, 2010s, even the 1990s. We saw very little, if you look at 1990, 2000 recessions, we saw very little drop in output, but a massive decline in labor. In this, I think, upcoming year, we're going to see a slower economy, but I think that companies continue to view labor as a scarce resource. I think the true Goldilocks is not going to be defined by output. It's going to be defined by the labor market. And we are going to see I think the unemployment rate stay quite low.
Laura, thank you. With FS Investments, Laura Rahm this morning there with a 1.4% call, slower economy here around the buoyant news. Looking back to September 30, the end of the third quarter, those GDP statistics that we just showed, and the complete showed, that's British, It's like northern medieval British. I showed it.
Definitely not anything related to an accent.
It's what's in the tang this morning. Okay. What I would say, Lisa, here that's so important with futures up 22, up 0.5%. And I'm going to do this on the Dow. I'm not even going to go logarithmic, but all of a sudden we're looking at record highs going back to the summer, the recent summer. And then you got to go back before that as well. A leg up off of Halloween in the present slope of good feeling from the middle of November when you bought your refrigerator. It's not as steep as the joy of early November, but nevertheless, there's a persistency to this that's without question.
And another day, S&P futures up 0.5% to 45.84. Tom, one thing I'm surprised you actually didn't bring up is just this idea that Wall Street Journal reporting that Apple has ditched Goldman Sachs, or Goldman Sachs has ditched Apple.
That's my
and
error.
The credit card. And you've been talking about the consumer banking efforts by Goldman Sachs and how it hasn't really taken off. And this is sort of the last sort of drop in that bucket. I thought it was really interesting, some of the details and the disagreements that have been simmering for quite a while between these two pairs.
Yeah, I'm not an expert on this, but I would say, I've got my own anecdotal evidence for this. There is a white card in my wallet, which I really, full disclosure, I'm not happy with. But separate from that is, and I would say this with great respect for Mr. Solomon and Mr. Cook, this thing was clumsy from day one. And I'd love to talk to Alec Webb or Dan Ives, or what's the guy we have in technology on the West Coast that gets up at 10 a.m.? He's stupid. Ed
Ludlow.
Ed Ludlow, yeah, that's it.
He
can never get up to talk to us. He's coming in from the bars. But I'd love to know what Ed Ludlow thinks about the clumsiness of what we've witnessed with Apple and Goldman Sachs.
Some of the details show how difficult it was from the beginning. For example, Apple's desire for there to be a very high approval rating, which led to a disproportionate number of charge-offs, things of that nature. But at the same time, this was sort of the crown jewel of the effort that Goldman was really going for.
Not an acquaintance here. I can find one AirPod, but I can't find the other AirPod. Can I go get a new pair of AirPods?
Buy now, pay later. Go ahead.
Yes, thank you. I'm aware of that. Futures up 21. Bloomberg Surveillance.
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also going to present risks that, other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Peter Zaffino, AIG's Chief Executive Officer, speaking with David Rubenstein. And you can watch more of David's conversation with Peter on Peer-to-Peer Conversations tonight at 9 p.m. in New York. I have to say, that really was the snippet I wanted to focus on, this question of artificial intelligence and how it's transforming, in particular, the financial industry. Tom, we were talking yesterday with Mike Mayo about just this this event.
And also the avoidance of the shocks at something like AIG sees, whether it's a given hurricane or war in Europe, or might I point out the Eastern Mediterranean. I mean, it's a different analysis by an insurance company than worrying about what it's going to do with productivity down the income statement. Can we get more gross margin about it? Can AI help them with disaster is the heart of the matter.
I am so pleased that we get to speak with David Rubenstein, co-founder and co-chair of Carlyle Group, host of Peer-to-Peer Conversations on Bloomberg Television, because David is somebody who talks with all of the executives across Wall Street, Main Street, and beyond to understand how they're dealing with some of these transformative technologies of the moment. And David, I want to start there, kind of where the similarities are in how some of these executives are thinking about the developments in artificial intelligence in generative AI.
Well, everybody wants to be an expert on AI and figure out how it's going to affect their company positively or negatively. But honestly, nobody really knows for sure yet how it will work. We're really in inning one of artificial intelligence in terms of how major companies are going to use it or have it used against them. So everybody's trying to hire artificial experts or get people into their firm who can help them assess whether artificial intelligence is going to be useful to them or helpful to them. And nobody really knows yet. So I can't say anybody is certain how it's going to impact their business yet.
David, Mr. Zaffino steeled at Marsh McLennan and others, and then on he goes to AIG, where different than other executives, he has to deal with disaster. What did you learn about how he handles the unexpected?
Well, insurance is about dealing with the unexpected, really. And so AIG became the largest insurance company in the world for many, many years. And as a result of that, it had enormous tentacles throughout the entire financial complex. It clearly extended itself too much, didn't anticipate problems that arose, particularly in the mortgage area, and as a result had to be bailed out by the U.S. government to the tune of about $180 billion. Now that money's been paid back with interest, but AIG is no longer the biggest insurance company in the world and doesn't have quite the tentacles around the world that it once did, but still a very profitable company.
David, a newsmaker yesterday, this is what Rubenstein does. He's steering the thunder from journalists. David Rubenstein with Bill Ackman yesterday on the track that this nation will take. What did you learn from Mr. Ackman, David Rubenstein?
Well, Bill is a very impressive person who obviously is outspoken, has been outspoken on many issues over many years. Recently, he's become quite visible in what he's been saying about Harvard. But he said in the interview, which will air not too long from now, that he's made a new bet. He's made a number of macro bets that have turned out to be extremely positive. One of them, he made over 100 times his money on a bet that he made a number of years ago in the time of COVID. Now he's made a bet that interest rates will be cut sooner by the Fed than is otherwise expected. And if that bet is successful, I guess he'll make a fair amount of money. But that's the big issue that many people are grappling with. Will the Fed decide that it needs to lower interest rates before the political season starts, let's say in the summer or the fall of next year?
Excuse me. Go ahead, Lisa. Please. My fault.
David, is it surprising to you that a big hedge fund manager is focused on making big bets on treasuries right now?
Well, many hedge funds people are doing that, honestly. He has not done the so-called treasury trade that others have done, where he's buying treasuries and shorting treasury futures. He hasn't done that. This is basically a bet that the Fed will succumb to some pressure to lower interest rates before too long. Now, the conventional wisdom in Wall Street is that the Fed will lower interest rates at some point during the first or second quarter, more likely in the second quarter. I think his bet is it'll probably do it sooner than the conventional wisdom. And I have said publicly before, and I still think it's the case, that the Fed will get in trouble if it lowers interest rates around the political season, because Republicans will say, well, you're helping Joe Biden by lowering interest rates if you do so over the summer or in the early fall. So if the Fed is going to lower interest rates, probably to avoid political criticism, it'll have to do it sooner than later.
David, you mentioned Mr. Ackman in Harvard in the horror of the Eastern Mediterranean. I want to go to your Duke University, where they have a bridge, folks. It's an old bridge called the Free Expression Bridge. And to make a long story short, they had to paint over a pro-Palestinian tone as well. David, I want you to talk to the great and good right now about how those of means and success should deal with their shock at our American universities.
Well, the American university system is still the envy of the world, and our private universities are really the places that people from all over the world want to attend. There's been a shock that many people didn't realize how strong the anti-Israel feeling has been in some campuses, and the result of that has been outraged by some alums. Some universities have handled this better than other universities. I'm the chairman of the board of the University of Chicago, and we have a tradition of not issuing statements on political matters or outside matters, and we haven't issued one in this case. But in many cases, other universities have not had that policy, and they've gotten in trouble for issuing statements that don't please one side or the other. It's a difficult way to walk this fine line, and I don't know that anybody has figured it out properly or correctly.
David, a glorious day for Bloomberg Surveillance with Doug Cass and Howard Marks with us in remembrance of Charlie Munger. Give us your thoughts on the hugely successful experiment that was Berkshire Hathaway.
For those who don't know, Charlie Munger was from Warren Buffett's hometown of Omaha. He moved to Los Angeles and later reconnected with Warren Buffett, who he hadn't really known before, but he had worked for Warren Buffett's grandfather at one point in a store. Charlie Munger was an outspoken, very, very smart lawyer who transitioned from being a lawyer to being an investor, and his track record early on was actually better than Warren Buffett's in some respects. They teamed up, became an incredible team of people who were mostly known to the public through their annual meetings, where Warren Buffett and Charlie Munger would answer questions for 6 hours on end. And Charlie Munger was quite well known for his, I would say, dismissive ideas of some other people's thoughts about investing. He was a very fundamentalist kind of investor, and he transformed Warren Buffett. Warren Buffett was taught to buy things very cheap, and buy things cheap, you can always make money. It was Charlie Munger's view that you should buy good companies. Maybe you pay a reasonable price for it, but buying good companies is better than buying cheap companies, which may not be that good. And Warren Buffett gives a lot of credit to Charlie Munger for having transformed his views on the investment world.
David, thank you for joining us today with this remembrance of Charlie Munger and, of course, with your excellence. Look for a conversation with Peter Zaffino, peer-to-peer conversations, 9 p.m. tonight, and hugely anticipated in the next 10 days, a conversation with Bill Ackman that I would suggest, moved markets, at least the trading market yesterday.
Well, Bill Ackman has gotten the timing pretty well so far this year. I think it's notable to me that hedge funds have been active players in making interest rate bets. Back in the day, they were more of the Charlie Munger make a big bet on a specific company, including Bill Ackman with his whole Herbalife saga. There is a question of whether interest rates are actually at the behest of some of these levered trades and how much that's played into the action of this year.
The action of this year is the bid is there. Even on moldy days, stocks seem to have, there's just this oomph right now. I guess it's seasonal. Some people would say that. Amy Wu Silverman would say that. But I got futures up 21. For the first time, folks, in years, I'm on like a record high watch on NASDAQ 100. A 16.1 and 16,500-ish is a record high. I've never said that.
It's the NASDAQ up 11%, more than 11% so far in November. It's been a great year, right? We were hearing that earlier this month, the month of November. But honestly, we did see that 10% pull down and boom. Was that enough to bring everybody back in?
I think I've got to see what Apple's Christmas holiday sales are before I can buy my first share of stocks. I triple leveraged all cash. You know, I mean, somebody said, do you really make 15%? 5 times 3, and I said, no, there's a lot of expenses involved. There's marketing expense, and, you know, the general counsel has to get their fee. And, you know, net clean, we're double digit, but we're not up at 15% as some people think.
You say that Apple revenues are going to be interesting. How much is it just going to be CPI? PCE, what we get from U.S. inflation, that's going to drive more valuations.
Well, and also, I'm going to go right over to the job economy. What if we get all this secret sauce John and Lisa are talking about in a fully employed America? I have to see on that. What it is a fully employed General Motors, and they will be making cost cuts. They make that very clear. their CEO, in conversation with our John Ferro here in this hour. It's Bloomberg Surveillance. Good morning.